Ladies and gentlemen, this is Cayden from VIA Value Investing Academy. I would like to thank every single one of you for attending our very first Value Investing Symposium 2021 online. And I'm in this very beautiful place over here, and I still remember vividly way back in 2018, we are running a very big event at Suntec, and there are about maybe 800 people attending. But the world has really changed a bit, so right now we can no longer run an event of that scale. But having said that, through online means such as YouTube Live, we'll be able to serve even more audience. So before I talk about what are the agenda for the day, maybe I like to bring you to a very quick journey of how this Value Investing Symposium got started. Now, if you look at the screen over here, it all dates back to way back to in April 2020 when this new virus called coronavirus, COVID-19, struck the entire earth and everybody get caught by surprise. And I still remember our Prime Minister Lee, called for a lockdown, or rather a circuit breaker, in April as well as in May 2020. That really took everyone by surprise, including my company. But I still remember a very famous value investor by the name called Sir John Templeton, and he once said, "Trouble is opportunity." So this COVID epidemic is really a trouble. But the interesting thing is, in the stock market, it brought new opportunities. Why? Because in March 2020, S&P 500 plunged to a new low, and it dropped 30% from most recent high, causing a market called a bear market. And during that time, I was thinking, is there any way for VIA to serve our graduates or the public better? That's when we launched the VIA US case study. So VIA started way back in 2010, and remember the coronavirus came in last year, which is March and April 2020, and that marks the beginning of the launch of our US case study. But before we provide a service to our main audience, we must know what are the challenges that any typical investor will face. And let me share with you some three important challenges that usually any typical investor will face. The first one is, if anyone want to buy any companies or invest in any companies, they must first know what exactly to invest in. So that is the first challenge. The next one is, even though they know exactly what to invest in, they may not know when to do it. Yep, so that's the second challenge. And even if they know what to buy and when to do it, the question is how much to buy, how to create a portfolio, how to do asset allocation so that their entire portfolio stays in a safe zone so that they never lose money. So along that challenges that I've said just now, we come up with a couple of simple solutions, but it took us really a lot of effort. And the first solution that we wanted to help investors, right, is every single month we decided to pool a team of people to analyze companies for them, and per year we set a goal of 24 companies where we want to share with our audience value investing style, and all these companies are predominantly good, undervalued, or at least fair value. And then not only that, for people, busy people, like for example doctors, pilots, people who are really busy, we wanted to give them something that you could take a very quick look in maybe 5 seconds or 10 seconds. So in our Project US case study, we launched a summary report as well as slideshow so that they can see all the case analysis in one quick glance. And that's not all. We wanted to have interaction with our audience, our subscribers. So we came up with a quarterly meeting where we will share what are the options, strategies that I personally use so that we can sell options together. Yep. And in addition, right, one of our beautiful program manager, her name is called Charmaine, so she was wondering, why don't we really meet the subscribers? So during phase 2 last year, we decided to organize dinners for our subscribers, and you can see on the screen over here, you can see there's 8 wonderful people. And just to let you know that I think there are at least one person called Brad in the audience right now, but unfortunately you can't see. But I'm really thankful to all the supporters for our Project US case study. But that's not all. Yeah, because in addition, we also launched our Bridging Value Investing program, because we know that out of 100% of subscribers, there may be 10% or 20% of our subscribers, they may not have attended our 4 days value investing program. So we introduced this Bridging VIP course so that they get to learn some of the technical terms that we use so that when they watch the case study analysis, that will put them at a faster track. But that's not all. because we have also launched the affiliate program last year so that every single subscribers have a chance to share with their friends about what we do. But again, that's not all, because not only the 3 services that are provided for our Project US case study subscribers, and just now I talked about item number 4, which is our bridging value investing program, and then we also share with our subscribers advanced cash flow option strategies so that they can double their ROI every single month when they sell options. And of course, recently we launched our regular company updates, because as time passes, some of the information may get a bit backdated. So we want to keep all our subscribers at the forefront of what the company is doing, which is item 7, regular company updates. And these are some of the case studies that we have found. In total, since last year, April, we have discovered 54 good companies which are already in our shopping list. And if you look at every single row, which are highlighted in yellow, and these companies are still good and undervalued. Now, the biggest dream for VIA for this Project US case study is to become the largest US collector of good, cheap and undervalued companies, and I really hope that all of you will jump on this project. And these are the 7 things that we wanted to help any investor to become a better investor. And eventually, how we end up with today's VIA or Value Investing Symposium 2021, because we're thinking, in addition to the 7 items, we want to do something better, do something much more to serve our target audience better, which is why this VIA Value Investing Symposium 2021 was started. Yeah, and let me just share with you a very quick view of who are the authors. As you can see on the slides over here, there are a total of 4 speakers, and I'm the host for the symposium today. And not only the symposium, not only get to learn, you also get to earn something, which is our prizes. And later on, we have 2 rounds of exciting prizes to be given out strictly, exclusively for our US case study subscribers. Now, if you want to win some prizes, right, on the YouTube live, can you please type "Hola" so that I cannot see, but because my iPad is over there. Now, so let me share with you what the agenda for the day, right? Just now I've shared very briefly how our Project US case study got started, and then after that I'm going to introduce the 3 speakers who are going to correspondingly share the 3 case study, and then we're going to take a very short break. Now, after the break, when we come back, we will have our round 1 of our lucky draw, followed by our dear Raina, who's going to share the 4th company, and then we will go into the round 2 of our lucky draw. And that's not the end, that's not the end. Right at the very ending of our symposium, I'm going to share with you a pleasant surprise. Yeah. So very quickly, we have done our number 1, item 1, and we've done our item 2. So right now, I'm going to share with you who are the 3 speakers for the day. Then we're going to have a panel discussion. Then we're going to go for a break. Now, the first speaker, his name is called Wikit. He's going to share with us a company called Discovery Incorporation. Just to let you know that Wikit is an engineer by training, and his profession is in the sales engineer in the automation industry. And I remember fondly when Wikit was doing the US case study analysis for us, you know, he was a pretty, very mild, soft-spoken person. So by putting Wikit on this stage, right, now with an audience of probably hundreds of people, is really a great challenge for him. But I'd like to thank Wikit for really taking this plunge, and he's actually sitting on my left side and then nodding, yeah, I'm going to do it. And so that's the first speaker, which is Wikit. And our very second speaker, right, is Dennis. So Dennis has a degree in communication, and he works in the healthcare industry. And I still remember probably about 6 months ago, I was, cooperating with Dennis. Can he help us identify some arbitrage cases, some merger and acquisition cases? And then Dennis was sharing with me that he really liked doing all this analysis. And then not only that, he came up with a super Excel file, right, that provides very nitty-gritty details of all the merger and acquisition cases. And I'm really thankful that Dennis is joining us this morning, and he'll be sharing with us this amazing company called Euronet. But that's not all. Now, our third speaker is Zheng Hong. Zheng Hong worked as an IT system administrator in an alcohol distributor company. Now, if you look at these three persons' background, for example, Wiki is in engineering, Dennis is in communication, and then Zheng Hong is in the so-called IT line, right? You realize that every single one, they came from a different industry. But that doesn't stop anyone from becoming a better investor, which is why I summoned, inverted commas, right, all of them here to really help every single one of you by sharing their thoughts on these three companies. But that's not all. Our very last speaker is our in-house equity research analyst. And Reina is really a very experienced investor because she has once told me she has been working in her father's brokerage firm for quite a number of years. And I'm quite glad that she's going to share with us one exciting company called Nvidia. And the reason why we picked this company is because a couple of weeks ago, we shared a very similar competitive company such as Palantir. If you watch our deep dive series, you have heard that Palantir, and we did one company that is purchased by Berkshire called Snowflake. And we felt that this Nvidia is in that realm, and they may be a closest competitor to these two companies. And Reina is going to share with us more detail about this company called Nvidia. And of course, I'm the host for the day. And what I'm going to do is I am going to pass my time to our very first speaker, and his name is called Wicked, and he's going to share with us his own company analysis. So let's put our hands together at home, right? And let's welcome Wicked. Woo! Yeah, must clap. Okay.
Okay, so good morning everyone, and thank you Cayden for passing the time to me. So I hope that everyone is as excited as I am for today's presentation, as today we'll be looking at a company known as Discovery Network. So I believe that everyone has actually watched television, and for this company itself is actually known as Discovery Network with ticker symbol DISCA. And it's actually in the communication sector with the media industry. So let's move to the next slide. For today's agenda, we'll be taking a look at what is DISCA and what type of company they are, the economic mode. For next, we will look at a quantitative analysis, valuation, and also why there is a recent drop in the share price, and finally, some of the expansion that they are looking at. So first, what is DISCA? They're actually a global leader in the live entertainment sector. So these are some of the companies or the media that they actually have. So in this case, they are, some of them will be Dodo or actually TLC. So about the segment that they are actually serving, it's actually on the US segment. And the next is actually on the international segment itself. So this too is the major segment that they're actually serving. For the type of company that they are actually having, we will take a look at the recent EPS. So by plotting the EPS into the VIA calculator, what we notice is that it's actually at a 2% or close to 3% growth. And in this case, we are actually looking at a slow growth company. But for today's analysis purposes, what we will be doing is that we will actually add one more point to our discussion, which is actually the year before, which is after the whole evaluation is actually holding at 9%, and it's actually a medium growth company. So now let's take a look at the economic mode for Discovery. For Discovery itself, it's actually having the economic mode of the following. So we will actually explain them step by step in the following slides. First, we'll look at trademarks and copyrights. So as for Discovery itself, as we know that it's actually an entertainment company, they actually hold Discovery Studios, which is actually a full live service production house that focusing more on lifestyle and also reality kind of productions. And not forgetting, they also have a Discovery Digital Studios, which actually looking more in terms of advertising, in terms of the lifestyle segments. So first, we will actually look at the trademarks and copyrights, which is actually summarized here. And next, the distribution network is also the economic mode for discovery itself. So what is actually covered inside distribution network is basically, they covers 220 countries and actually covers 53 languages as well. So there are three major segments in this portion, which are Asia Pacific, Europe, Middle East, and Africa, which is summarized as EMEA, and also Latin America. And basically this covers the whole economic mode for discovery, where they are actually covering a wide network in terms of the whole world. And as for brand loyalty itself, this is the CEO of Discovery. So the CEO of Discovery, David Zaslav, actually mentioned that we actually achieve 18 million subscribers, which actually shows that they are gaining brand loyalty to its subscriber. So in this case, it's also one of the economic mode for Discovery itself. So basically, these 3 points summarizes the economic mode for Discovery. And after understanding these 3 points, we shall look at a bit more of the numbers on how the company is actually doing in terms of its economic mode. So by looking at numbers, we will take a look at ROIC to WACC. So to some of you which are new to this term, ROIC simply means return on invested capital. And from this graph itself, we are actually looking at dropping in terms of ROIC, which actually the most significant drop in the recent years. However, for WACC, which is the weighted cost of capital, it's actually fairly constant, ranging from 6 to 8.5. And in this case, if this company is having a wide economic mode, we should expect a huge difference between them. But this is not really the case for the recent month or the year itself, which is actually at 0.18% for the year of December 20. For this case itself, what we should do is we shall further analyze on what is happening during last year. So this is actually a snapshot from the financial report. So over here, what we notice is that the revenue from the company actually dropped in the year of 2020 as compared to 2019. And taking a further look at the whole financial report, what we notice is that they actually plan to have a further capital expenditure in their whole portfolio. So what is this expansion itself? It will be further discussed in the next few slides. So with this expansion, what we will be expecting is that this high expenses is going to be incurred. That is actually summarized in this financial report. So what is actually highlighted here is that the lower return and higher invested capital causes the ROIC actually to be lower in the year of 2020. So as what we mentioned just now, we need to understand what are they using this investment for, which actually will be covered in the next few slides as well. So after understanding the economic mode, we shall take a look at the quantitative aspect of the whole company. So first we will take a look at EPS. So EPS itself is a good indicator for us to know whether this is a good company, as what we are expecting for a good company is that it will have a positive EPS and also a stable, or if it's actually on the uptrend, it's actually better for us. So in the latest EPS, we can see that it's actually a stable trend and it's actually positive. So for our VIA framework, we are giving this company a pass for its EPS. As for gross margin, we will be actually looking at more on the profitability of the company after deducting its total direct costs and also labor. So in this situation, we are giving a framework of if the gross margin is more than 40%, it's actually a good company. And in this case, we are observing the following trend based on the VIA framework. So it's also a pass for the gross margin for Discovery. As for operating cash flow, we are looking at the operating efficiency in the company itself. So what we should expect for this is if it's actually at a good financial health, we are looking at a positive operating cash flow. And if it's actually stable, it's better if it's actually going on the uptrend. So on discovery, we observe that it's actually positive, and overall, it's actually going upwards. So in this case, it's actually a pass based on the VIA framework as well. As for free cash flow, it's looking at the operating cash flow after deducting all the capital expenditure as well as the operating expenses. So what we should observe is the similar trend of the operating cash flow. And in this case, we are also observing the same trend, and it's also a pass based on the VIA framework. Now for return on asset. Return on asset normally looks at the management point of view on how much they can actually get in terms of the asset that they are actually holding. And for this case, we'll be expecting this to be actually positive, or we are actually looking at a stable trend for discovery. So for us, it's also a pass. As for return on equity, this actually highlights also the point of management where it calculates how much investors' money is able to generate the income back for the company. And for this, it's also a stable trend for discovery, and we are giving this a pass as well. Now, finally, we will look at the debt to equity. So debt to equity is actually quite important for the company because it basically shows how well the company is actually using the debt to actually maybe further expand, or what are they actually using the money for. For us, we are actually observing a spike, but overall it's a stable trend. But because of the spike itself, we are now giving this fail in terms of our VIA framework. But definitely, we shall further analyze on what is Discovery's future plan in terms of using the debt itself. So this is actually the valuation for Discovery. After keying in all the values that we have summarized so far, we can notice that the first value is actually highlighted here. And by doing the second evaluation to maintain the same growth due to the previous data itself is actually half of the growth rate, we are expecting the second valuation, which is actually shown on the screen. And for the third valuation, what we notice is that this is a snapshot of the current stock price of Discovery. And this price itself, we are actually including inside our valuation to understand further. To achieve this current share price, the expected growth is around 13%. So basically, this is something that we shall look forward on whether the company itself can further grow from this point onwards. So with that, we will come to the next slide, which is on the stock price. So for Discovery, it actually went through a bit of roller coaster for its stock price. So why is it so? But before that, let me just show you what does the roller coaster means. Basically, the highest price that they actually aimed to reach was around $80. But in March 26, they actually plummeted a lot, and it has the highest trading volume on that day itself. So for this, I think everyone will be more interested to know what actually happens on March 26 this year. So for this, we will take a look at two major points. As the first point is actually based on analyst review. So based on analyst review, they are actually looking at the streaming services should not, doesn't justify on its actually triple increase in terms of its value and causing this to drop. But this would not cause such a huge drop actually. So what actually happens on March 26 is actually a company known as Archegos meltdown. So this is an event where the bank offers a prime brokerage service to a company known as Archegos, which actually force Archegos to liquidate their value of shares because they are unable to meet margin calls. So for Archegos itself, we can see further details in the next few slides, but this actually caused the stock price to dive around 27% for both media company, which another one is Viacom besides Discovery. So let me just give you a perspective on what Archegos is. So Bill Huang, I think some of you might have noticed this biggest event that happens in Wall Street is actually the person in charge behind of Archegos. So what they actually did was that they have this large holding in terms of the media company known as Viacom and also Discovery, and they are actually exercising a kind of strategy which is known as total return swap. So for this total return swap, it actually backfired Archegos, as this was not actually listed in their company's portfolio. And when Viacom actually launched their new shares, it actually caused Archegos to go for this margin call. And because Archegos doesn't have sufficient fund to meet the margin call, they are forced to liquidate their current stock that they're holding. So in this situation, it caused them to liquidate a huge amount of Discovery stock. And in this situation, it actually caused the share price to drop significantly that we actually just showed you in the previous two slides. So what we can actually observe is that this basically is a one-time event, but we are actually looking at a company to further analyze, and if it's a good company, we shall look at its future plan. So in this case, we shall look at what Discovery is actually aiming for in the future. So first, they actually announced a new expansion known as Discovery Plus. So this is actually Discovery Plus that was actually launched last year, December 2nd. So what is Discovery Plus is basically mainly to go for a different kind of segments, where this chart itself summarizes the whole segments or the portfolio that Discovery has. So they are actually having US linear, international linear, Go, and now to actually further expand their market, they are actually looking at Discovery Plus, which is actually over here. And for this Discovery Plus, they managed to secure a key distribution partnership, which is actually listed over here as well, which is Verizon and also Sky. So Verizon is aiming for 50 million subscriber to offer this service to them. And for Sky itself is actually more on the international market. So this is their prospect for Discovery Plus, as we shared, as it's actually shared in its investor relation. So they are actually aiming to look at increase in terms of revenue for 70 million in the US market and 400 million in terms of the international market. So basically this itself is an event that happened last year. So something actually happened this year as well, which is even more exciting. So let's take a look at what is happening for this year. I guess some of you might have heard of the company known as Warner Media. So in this year, May 17, they actually have this plan to actually combine their operation to be another new kind of strategy partnership to be the leader in terms of the entertainment sectors. So this was actually announced on the 17th May this year, and they are expecting to complete this whole process in mid-2022. So with this further collaboration between both of them, they're actually aiming to have more than 200,000 hours of video contents and also the high quality production. But what is more interesting to us is actually the diagram at the bottom. So basically after the collaboration, they will be actually looking at 20 billion in terms of the whole company value, as it surpasses Netflix of 17 billion and also Disney. So this is actually a projection that Disney for Discovery is actually aiming for. So this is some of the things that you can actually expect if both of them are actually able to collaborate with each other. So this is some of the financial highlight. They are actually looking for greater scale in terms of the expansion. And then for this, they are also taking a look at further cost saving in terms of their production. And then for them, they are also looking at direct-to-consumer revenue. And finally, they can actually generate more free cash flow for further expansion that they will be looking at in the future. So this is the highlight for Warner Medias. Finally, we will take a look at the recent income statement or how well they are doing in a recent quarter. So take a look at the income statement that was actually gathered on the 30th of September, which is just last quarter. So what we are observing now is actually highlighted. So what we expect is actually an increase in terms of revenue and also an increase in terms of the expenses. So by understanding there is an increase in both of them, we should also understand why is there an increase. So for revenue itself, it's actually covered by three portions, namely advertising, distribution, and also others. So for advertising, the revenue increase is mainly due to the recovery from COVID-19 in the international market. And for distribution, it's actually mainly gathered from the Discovery Plus in the US market. And for others, they actually increase based on the Olympic event that happened just this year. So basically, these are the three main points for the revenue portion. And for expense itself, it's actually contributed by 2 points, which the first one is actually the Olympic event, and the second one is the further expansion that they are actually doing for Discovery Plus. So this is some further analysis in terms of the income statement. So we can also see that the net income itself is also a positive sign. And what we should actually highlight more is actually the portion at the bottom, which is actually on the cash flow itself. So what we observe for the cash flow is that they actually have a huge increase in terms of its cash flow, which actually for investor, when we are evaluating a company, it's actually a good sign for us, since cash itself can actually allow a company to do more things. So actually from their recent income statement, it's quite decent for us. But we shall also look at one more point, which is the operating income before depreciation and amortization. So this will take up some of these accounting terms, but which is actually the depreciation and amortization, which cannot actually which is not the real money that the company actually can to further use. So in this case, what we observe is that total revenue and also the expenses is actually what we have shared before, but the overall OIBDA, which is the operating income before depreciation and amortization, is actually on a slight, which is on the negative side. So we shall actually take a closer look at the financial report that will be coming out during December to understand how well are they actually doing based on all this planning that they have, which we have covered just now. So with all these things, I will end my presentation for Discovery, and I will next pass the time to Dennis, which will share with us another exciting company. So thank you so much.
Good morning, everyone. Thank you, Vukiet, for a very exciting presentation of Discovery and its related content. Today, I'm the second speaker for this Symposium 2021, and I would like to present to you this particular company known as Euronet Worldwide. Some people will call this a credit card service company. Note, it's not a credit card company, but a service company. Some people may even call it a payment processing company. So my aim today is to try to share with you in a simple manner to understand this company that has many different business segments. Today, this is the agenda that I'll be following up from the previous symposium, and this is actually an update on this particular company, which I covered for the 2019 figures. So I will do a recap of the circle of competence, as well as some of the future updates from the chairman's statement. So what the chairman said before and what he says today. Let's see how has he delivered so far and what is the progress. As well, we'll discuss a bit about the economic mode in terms of the quantitative as well as the qualitative based on 2020 figures and the trailing 12 months to date. As well, let's talk about some financial ratios of the earnings per share and the gross margin. For the cash flow, from the operating point of view, the free cash flow point of view, the return on equity and assets. Also, we'll take a look at the debt in terms of short-term as well as long-term. Also, we will also look at the long-term trend of the shares outstanding, whether is it on a downtrend or is it on an uptrend. And finally, in the final two segments, I'll provide a key updates on the 2021 current state of the company, as well as the current price to book value and the valuations methods that we're going to show today. So let's recap on what Euronet is all about. In a nutshell, they have three major segments. The first segment will be the electronics funds transfer. So Euronet, actually, they provide ATMs. So you may think that ATMs is a very commonplace thing. So let me just put things in perspective. Let's say in Singapore, when you see in the retail mall, you see DBS, you see OCBC, you see UOB, right? Are these costs to the banks? Yes, because the banks have to put the ATM there to provide the service to customers, and they have to pay rental, right? So to banks is a cost. Okay, so now let's switch to Euronet. To them, Euronet is, they make money from ATMs. How do they do that? If you look at the picture at the bottom left, you'll see Euronet's ATM machine. So these are at international airports around Europe. So airports actually engages Euronet to place their ATMs there because their ATMs are capable of dispersing multiple capabilities, including multiple currencies, dispensing prepaid cards across different jurisdictions and different countries. Hence, it's an all-in-one machine that they can cater to international travelers, and hence this is one of their revenue streams that they provide under the EEFT segment. The second segment will be virtual, electronic, known as ePay, which you can see in the middle, the logo there. Okay, what is ePay? Right, so who are Euronet's clients? Some examples, Apple and Google. So if you go to the App Store or you go to the Google Play Store and you buy a gift card for your family members or your friends, right? So Google and Apple, they just do the rah-rah, they do the marketing, they sell the gift cards, you buy the gift cards. But who does the back-end processing? Who earns that money? Who pays the person to do this, right? So Google and Apple actually pays Euronet to do all the back-end processing for the ePay, such that when you redeem the gift card, it is seamless transaction. Right, so Euronet has the technology know-how to do this. The third segment is money transfer. So in the world today, right, physical money is still a very real thing. If you look in the worldwide transactions, right, approximately remittances, about 90% still accounts for cash-based. So for example, if you look at the right-hand picture of RIA, RIA. So you know these are physical remittance stores. For example, other competitors will be like, they come to mind, like for example, Western Union, etc. So RIA is actually under Euronet, which was acquired by Euronet several years ago. So RIA does remittances for example, for workers who work overseas and they need to remit money back to their home countries. So RIA is internationally, they have many, many offices, right? So for every remittance, they take a cut, right, from the customer. So that's how they earn money from RIA. How about the balance 10% of transactions in the world? And that will be digital-based. And what type of providers have this for digital-based will be xe.com. I'm sure that a lot of us will be familiar with xe.com. For example, if I'm traveling, I need to know the currency exchange between Singapore and US. Where do I go? I go to xe.com. But do you know the XE was acquired by Euronet many years ago and belongs to Euronet. And XE, not only are they a currency converter, they also provide remittance services digitally. Right? So this is something that you should know about XE as well, and it's under Euronet. So these are the three key segments. Next, let me dive into some of the numbers of the circle of competitors and an update with 2020 figures. If you look at the top screen in blue, that was previous year from 2018 to 2019. Look at the green arrow. You can see year on year, last year, it was fine, right? The revenue went up. However, if you look at the orange below, you see year on year, the revenue has actually declined for the full year of FY 2020 December. Okay, why is that so? If you look at the boxes in green as well as red, you can see the percentage in terms of the revenue for that year. And you can see that EFT processing has actually declined quite a fair bit. Okay. However, you will notice that ePay as well as money transfer, these two segments has actually, in terms of absolute numbers, have actually increased. Okay. But however, on the overall value, the revenue has gone down. So we will just dive into that a bit more in the later slides. So you will be able to see that on the bottom right-hand side of the operating margin, you can see same thing from 2018 to 2019, it was an increase, but in 2020, it went down to about 6%. So let's see what contributed to this 6%. And also to recap on last year, 2019, when I covered this particular company, I covered one risk, which is known as goodwill impairment. Okay, what is goodwill impairment? Okay. For big companies, for Euronet, it's very common for them to acquire many businesses throughout the years. So as they acquire all these businesses, as you can see in 2019, the company's assets in the balance sheet, goodwill consisted about almost 20%, which is actually quite significant. So what happens in an audited financial statements is that the auditor, year on year, will need to do an analysis. By accounting standards, what they need to do an impairment analysis. So they need to know whether the businesses that they own, are they really worth as much as they claim to be year on year? And you can see that all of these acquisitions, Euronet has many key markets as shown on the screen. You can see markets like Greece, and in Asia they have in Malaysia. So you'll notice quite noticeably, you can see China is not there. Right? So if you want to know whether Euronet is in China as a payment processing company, okay, the answer is no. So when you can see all these key markets, they need to have operating results year on year. They need to have good results. The moment they have bad results, okay, the auditor is required to actually lower the goodwill amount in the balance sheet. And when you lower the goodwill amount, it will translate into an expense in the income statement. And what happens to that? It will naturally translate into a lower earnings per share, which will happen, may happen in 2020, because this was discussed in 2019. And true enough, in 2020, which I'm discussing now, it has happened. And that's the reason of the lower operating margin of 6%. But 6%, take note, that is a number derived by Morningstar. Okay? But in actual reality, it's even worse. Look at the bottom number, it's only about close to 2%. So you can see that Morningstar actually excluded the non-cash expense of goodwill impairment below in the red box. And in the red box, you can see that number there. If you include that expense in, the operating margin is only about 2%. Right? So by accounting standards, this is required to be placed in, and that will affect the earnings per share for 2020. And for this particular impairment, out of the three segments, the one that was impacted the most was the money transfer segment, which is the third segment. So this money transfer segment, how much did it contribute to the 106 million impairment loss? Okay, out of the 106 million, about 80 plus million was contributed for the money transfer segment. So you can see in the financial statements, this was disclosed. You follow the red arrow, you'll be able to see the 80 million plus. Okay, so now you ask yourself, why did the money transfer suffer so much? Okay, so for example, money transfer, you will think of for example, the remittances, right? So you know, because of COVID-19, a lot of the foreign workers and things like that, some of them had to stop work. Some of them went without work for long periods of time. And when there's no money circulating, there's no money to remit back, etc. So naturally, and you know that in worldwide remittances, 90% is cash-based. And when there's a pandemic and there's an economic impact, right, naturally remittances become lower. And as a result, the cut that Euronet takes will also become lower. So naturally, right, this money transfer segment, this particular one reporting unit that is disclosed in the financial statements was impacted quite greatly. So the auditors had to do an impairment of about 80 over million for FY 2020. Next, let's recap of the type of company that we are looking at for Euronet for an investment purpose. Based on value investing methodologies, you can see that unfortunately there's no dividend yield. So for this company, you must either go for capital appreciation or via derivatives like options. Next, let's touch on the future plans of this company, the circle of competence. So you can see the chairman's message. So on the left-hand side, you can see is the 2019, what I shared about their ecosystem. So you can see the picture on your right is the ecosystem. As I mentioned earlier, you can see that there's RIA, there's XE, there's the electronic fund transfer segment. So they form an ecosystem. So this ecosystem seems rather vague, in all honesty, right? However, I would like to point out that this is actually, in simplistic terms, is more of a B2B framework, business to business framework. Why do I say that? Okay, look at the two ecosystems first on the left-hand column, which is the payment clouds and the REN Foundation, which provides microservices to companies. So for payment cloud, how they earn revenue is through the model of SaaS, known as software as a service. Let's give another example. For Microsoft, when you use your Microsoft Word, Excel, PowerPoint, now Microsoft charges you a monthly subscription, right? You no longer can buy off the shelf for the latest updates. You need to pay them a monthly subscription. So this is an example of a SaaS, software as a service. So likewise for Euronet, their payment clouds, their online payments, they provide it as a subscription basis. So they earn recurring revenue. And for the REN Foundation, for microservices, they earn licensing fees from organizations like governments, worldwide bodies, etc. So if you look at the 2020 update on the right-hand side, the chairman has actually updated that there was a real increase, a huge demand for real-time payments, which means they need instantaneous payments across jurisdictions, across countries, increasingly. And Euronet has stepped up their infrastructure to be able to meet the increasing demand for this in the world that we can't even meet anymore, and increasingly we are going online. And secondly, the chairman's statement for the microservices, he has disclosed that there's been increased licensing demand from governments worldwide. It only goes to show that for the back-end processing for such microservices, right, there has been an increasing demand internationally, and this is showing up in Euronet's annual report. Next, let me touch on the economic mode for the qualitative portion. So if you look at the net margin in the red box, you can see that they have made the loss. Right? So to recap, is due to the impairment. So to recap, this impairment, right, is a non-cash expense. So that means this 106 million that you see in the books, it doesn't mean that you take out 106 million and you pay somebody. No. It is a theoretical loss. Okay? It is not real cash loss. Okay, so just to recap on that portion, but nonetheless, it affects the net margin for reporting purposes. Next, I'll talk about the quantitative portion of the ROIC and the WACC. So this is the updated trailing 12 months. As you can see, the blue line and the orange line. So the blue line is the weighted average cost of capital, which you can see is pretty constant, right? It's almost like a straight line. However, you can see that the return on invested capital is quite volatile, but nonetheless, based on value investing methodologies, what you should be looking out for is that the orange line and the blue line, there should be a gap, and preferably the orange should be above the blue line. So unfortunately, at this trailing 12 months, there has been a dip, right? Largely due to the economy as well as continuing acquisitions by an investment commitment by Euronet, which I'll share later in the key updates for 2021. Okay, so next we will go to the financial ratios. So just to recap, right, this is a negative earnings per share, right, as you can see on the right-hand side by the red line. So if you take out the impairment loss, right, in a theoretical situation, right, the earnings per share hypothetically would have been 1.96, which is without the impairment. So just to give an example, which will be similar levels to about 3 to 4 years ago. And just to show you the latest 2021 quarters, Q1, Q2, and Q3 for the latest quarter ended September. So if you look at the revenue per share and the earnings per share, you will be able to see the numbers have recovered to a certain extent. So based on value investing methodologies, this is a good sign. However, Mr. Market has spoken, right? Which is like a voting machine, right? The stock market is a voting machine. People are still voting the stock down. So if you look at the last 1 year since I last presented, you can see that it reached a high of 164, right, before going on a steady downtrend to about $107 as of last night, 3rd December. So that is actually about a 34% drop from the recent high 164, which we will talk a bit more a bit later. So next we'll touch about the gross margin. So you can see the gross margin based on value investing methodologies, it should be more than 40% or a positive and uptrend. So in this case, it has been positive still, but has been a drop, but it's still hovering between 30 to 40%, so this is still okay. Next, I'll touch on the cash flow from operations and the free cash flow. So first, from operating cash flow, you can see that it should be on a positive and uptrend as well. So if you draw a line across the 10 years, you can see a general invisible line is still on a general uptrend. Nonetheless, in 2020, there was a slight dip. And the same goes for free cash flow, which is the operating cash flow minus the capital expenditure. So similarly, there's been a slight dip as well, and it's been pretty consistent with operating cash flow, and also partially due to the capital expenditure. Next, I'll touch on the return on equity. It should be based on value investing methodologies, more than 15% or positive and uptrend. So you can see in this case, it is a negative number. So similarly to recap, it is due to the negative net margin. The company made the loss in 2020. Hypothetically, if you remove the impairment, the ROE will have been about 7%, which is shown by the dotted green line. So nonetheless, right, it is not more than 15%, but at least it is still currently on a positive and on a general small uptrend in general. But nonetheless, we still need to monitor this going into the 2021 full results. Next, we'll touch on the return on assets. So for return on assets, just to recap, right, the negative return on assets similarly is negative due to the impairment. And hypothetically, without the impairment, it will have been a hypothetical positive 2%, shown by the green dotted line. So similarly, it should be more than 7%. So this is something that we also will need to monitor for 2021 full year results. Okay, next, let's touch on the debt in the short-term perspective. So there are two ratios that we will look at based on value investing methodologies, which is the current ratios and the quick ratio. So in a nutshell, the more than 1 is a good number. So the example here, if it's 2, it means that every $2 of current assets, you have enough to pay for $1 of current liability. So you can see from the table below from Morningstar, from the black underline and the red underline, are the current and quick ratio. And you can see that both numbers, despite a poor showing in 2020, are still positive, which only goes to show that this company, despite taking debt in terms of their assets, right, they are still able to cover their liabilities in a healthy range. So based on value investing methodologies, this is a good sign. Now, let's take a look at the long-term perspective. It should be less than 50% or on a downtrend. So you can see this is the converse. You can see in recent years there has been an uptrend, and in fact, it has exceeded 100% or otherwise 1.07. So for every $100 they have, they actually have debt of $107. Okay, so let's investigate why is this the case. You can see that the long-term debt and the lease obligations are the numbers circled on the left. So if you add them up together, it's about 1.5 billion. So as you compare to the equity, is about 1.4 billion on the right-hand side. So when you divide debt over equity, that's how you get 107%. So just to explain out of this debt, about let me see the number. Okay, the 1.4 billion. You can see here, right, out of the 1.4 billion as disclosed here, there's a portion under the credit revolving facility, right? So you know every big company, they always have this credit facility with major banks, okay? As much as possible, usually organizations will try not to touch the credit revolving unless necessary, okay? So if you read a lot of annual reports, usually this credit revolving usually is not touched. But in this case, for Euronet, they have touched it. Okay? But nonetheless, for FY 2020, even though they had this debt, there is a disclosure in the annual report that this amount of 270 million has been fully repaid in January 2021. So it only goes to show that they can take the debt, but they are also able to pay it promptly. So based on value investing methodologies, that is a good sign. Because when a company takes debt, it is because they are either improving their physical infrastructure or their software infrastructure. As you know, for this company, they have both, right? So it can be quite intensive in terms of needing the money. So otherwise, for the rest of the debt that you see in the financial statements as shown on the screen, these are more of the long-term debt that will mature in the 1 year or later. So next, let me touch on the shares outstanding. So you can see for the last 3 years, the highest share outstanding, the highest share repurchase was done in 2020. It's about 200 plus million. And you can see year on year that has increased. So if you look at the table below, compared 2019 and 2020, you can see the number of shares has decreased. And based on value investing methodologies, that is a good sign. Because lesser shares means the profit is shared among a smaller pool of shareholders. So next, let's touch on the price to book value. And let's do an update on the 2020 figures. And you can see that the current trading 12 months and the 5 years average, you can see the current price to book value is actually lower than the 5-year average. So this is actually based on current valuation, it is actually lower than the 5 years. So this is a good sign. So next, let me touch on some key updates. And this is the exciting part, and it also will let you understand the company better. The acquisitions of FY 2021 as well as the valuation for the trailing 12 months. So first, let's talk about one key acquisition that they did in one of the key markets known as Greece. So in Greece, they actually acquired this company known as PBMA for short. Right? This PBMA is actually a credit card company, online payment company, and a mobile payment company. In Greece, look at the disclosure. In Greece, the government is actually imposing a tax on residents if their annual expenditure falls below 30% if they do not pay online. So that means in Greece, they are increasingly encouraging people to go cashless, and they are tracking their annual expenditure through their income tax returns. And they will impose a tax if they do not participate in enough sufficient electronic payments. So PBMA is the infrastructure in Greece to help them process these contactless payments. Just give an example in Singapore, right? If you go to hawker centers, you will see you can pay by GrabPay, you can pay by Amex, you can pay by Fave, you can pay by last time, there are quite a lot of payments, right? Singtel Dash example. But do you notice that all these, right, are all administered by NETS? So NETS is your back end who earns the money from processing all this at a holistic level. So similarly, PBMA is like that. And now PBMA belongs to Euronet, or however, I caution to say, not yet, because the deal was announced in March 2021. It will be closing by end of December. Nothing goes wrong, this company will belong to Euronet, and the revenue from these electronic payments all belong to this company from now on, in time to come. And not only that, they will also cross-sell to RIA as well as ePay to their fellow merchants. So it's a B2B synergistic marriage per se. So based on value investing methodologies, this is definitely a good sign. So let's look at the trailing 12 months valuation. As you can see that on the bottom of the screen, you can see the price to earnings, the current and the 5 years. The current is lower, so that's a good sign. So if you reverse engineer the formula of price to earnings and taking the earnings per share trailing 12 months, you'll see that the valuation is 14.78. And I also compare to the price to book value. If I reverse engineer it, the price will be 14 plus or so, no, 10.76. So you take the, sorry, I beg your pardon, about 101.76. So 114 and 101.76, you take the average, divide by 2, okay, and that will give you the target buy price based on the average valuation, based on the current trading 12 months. So let's look at the current share price. Is it around this share price? So now you can see as of last night, the current share price is below the target buy price. In fact, if you look at the 52-week low, as shown by the yellow box, which had only happened a few days ago, right, it reached as low as about $101. So at the currently, it is below the target buy price for investors to take note. So next, this is my second last slide, and this is the Guru Focus's own valuation for comparison. And you can see Guru Focus is much more optimistic, and you can see by the dotted black line, they quote it as 158. So the red zone on top is overvalued, and the green zone below is undervalued, and the blue is the price, the current share price. As you can see, it's quite volatile. So you can see that currently it is below the dotted black line. So based on Guru Focus valuation, the current share price is undervalued. And last but not least, I'll share with you Morningstar's valuation, which is 118.97. So you can see that based on current share price and Morningstar, you can also see that the current share price is also undervalued. So based on what I have just mentioned, the trailing 12 months, Guru Focus, and Morningstar, you can do your own comparison and based on the current share price. And this is for my sharing based on value investing methodologies. And with that, thank you for your attention. And now I'm very proud to present our next speaker, Zhen Hong. Zhen Hong, please.
Good morning, everyone. My name is Zhen Hong, and I'm your third speaker for the day. Actually, fourth counting Cayden. All right. So, being the third speaker, the good thing is I can hitch on the things that the previous presentation has already presented. Okay. So, for today, we're going to relook at this company called Methode Electronics. The ticker symbol is MEI, and for our US case study subscriber, it is case study number 18. Okay. So, agenda for today, we are going to recap about what Methode Electronics is. What, where, type, and the mode. Then following that, we're going to look at the latest reported numbers as well as do some reanalysis. All right. Then after that, we're going to have the intrinsic value update, and we'll cap it off with an after action review. Okay. So what Methode Electronics is all about? Okay. So basically, it is a manufacturing company that deals with customizable engineering and application-specific products. There are 6 different categories in it. The first one on the left side, which is the user interface, which mainly handles things like your touchscreen, knobs, switches. Then following that, we have the LED lighting category, which is a very simple category. It's just LED lighting, but it's more on the industrial context. So for example, if a customer wants a certain portion of their machine to light up, they'll probably engage the products of Methode Electronics. Okay, then after that, we have the sensor category, which handles their patented sensory technology. For example, their contactless sensor and switch combo. Okay. Now on the right side, we have the medical segment, which is also another straightforward category. It's just medical devices. Diagonally down, we have the power distribution, which is nothing more than just the transmission of power using connecting cables, transistors, etc. Then the last category we have is digital data, which is also a very simple category. It deals with the setting up of the infrastructure of the data network. Okay. So right here, I've taken from the investors presentation. We have the categories listed on the left side. Then they are ranked by sales. As you can see, the user interface is about 62%. Then in the middle portion, we have the different types of products that are within the category. Okay. So example, LED lighting, we have the valley switches. Sorry, the lights. Then the power distribution, we have the cables, etc. Then on the right side, we have the pictures of what the products are. Okay. So now having known all the products, we would want to know who their customers are. So again, taken from their investors presentation, we have in the middle portion instead of the products, we have the industry where the customers come from. Okay. Now on the right side, we have the various brands that are actually customers of Methode Electronics. So for those with keen eye, we'll probably see that we have repeated customers, for example, GM, General Motors, they appear in the 3 categories. And also everyone's favorite conversation topic, Tesla, appear in 2. Then for our local ego's sake, right, our local hospital, Singapore General Hospital, is a customer for under the medical segment. Okay. Now, for where do they do their business, right? Methode Electronics is mainly a global company. So it does its business in 3 major areas: US, UK, and Asia. All right. Then as for their key manufacturing site, they have 5. 1 in Central America, Mexico, 1 in Europe, Malta, 1 in Africa, Egypt, and 2 in Asia, specifically China. Okay. Now, as for the type of company, okay, using our latest earnings per share, the reported latest earnings per share, and calculated using the in-house VIA calculator, we have gotten the growth rate to be about 14%. Then previously, the author of the case study did a calculation, and it was to be at 17%. So based on value investing criteria, any value that is more than inflation but less than 20% is classified under medium growth. So whether is it the previous number or is it the current number, both are still under the medium growth category. So let's just keep this in mind for now. All right. Now, as for the modes, okay, the author of the case study identified 3 different aspects. The first one, brand loyalty. It comes about when there's a large pool of customers and both parties benefit from the idea of cross-selling. Now, also brand loyalty, most of it comes when there is a certain degree of respect or certain degree of recognition. Okay, so to that, Methode Electronics, like in their investors presentation as well as the annual report, they claim or they state that they have the recognition of excellence given by Ford and General Motors. Okay. Now moving on to good distribution network. Okay. As we can see back here, it is a global company. That is why the global presence is there. And then the author of the case study previously also mentioned that under the manufacturing aspect, it is vertically integrated, which means that Methode Electronics don't just do manufacturing. They manufacture, they pack, and they ship. Okay. Then the third point for this good distribution network is the partnership, where they partner with, say, key industry players such as the aforementioned Ford and General Motors, so that they can reach out to indirectly to the customers of Ford and General Motors. Then the last point, high switching cost, right, comes about when there is an integration of technology, which most companies like to do. So what they do is they integrate various products together into one system or one item. So if a customers were to purchase that particular item or system from Methode Electronics, and let's say they want to switch, okay, they don't just need to switch that a portion that they're not happy with. They need to switch the whole system, and that could possibly incur a high cost. And that's why the term high switching costs. Okay. Now moving on to the quantitative aspect of the mode, right? We always like to look at 2 things: ROIC and WACC, return on invested cost of capital and weighted average cost of capital. Specifically, we are looking at the difference between both of them, okay, which is ROIC minus WACC. Okay, then this graph here, I've taken from Group Focus, and how to read it is very simple. The green bar represents the ROIC, the red one represents WACC. The black line and the circle, as well as the numbers, represent the difference between them. Then value investing criteria wants ROIC to be more than WACC, hence the difference has to be positive for us to quantitatively say that there is a mode. Okay, so based on that, we can see that in the last 8 years, starting from 2014 all the way until 2020, there is the numbers appears to generally to be positive, and therefore we can quantitatively say that there is a mode for Methode Electronics. However, if the difference is smaller, okay, means that the mode is weakening. Or if the difference is larger, means that the mode is getting stronger. So in this case, right, in the recent years, the mode appears to be weakening for Methode Electronics. And this, again, we need to keep at the back of our head, so that later when we do our valuation, we will need to input discounts for our valuation. All right? Now, speaking of valuating the company, right, The author of the case study previously conservatively calculated the intrinsic value to be about 24 to 46 USD with an average of 33. Okay, so with that we have come to the end of the recap. Okay, so now we will start by looking at the latest reported findings, starting with the earnings per share. So earnings per share, generally it is on the uptrend, which is good. All right. However, in the last year, we can see that there's a slight decrease from 3.26, 3.28 to 3.19. Okay. Then the formula for earnings per share is as follows: earnings divided by shares outstanding. So look at the two moving portions, right? If the earnings decrease, then the earnings per share will decrease. Or if the shares outstanding increase, then the earnings per share will also decrease. Now, in the worst case, both will happen. Okay, but ideally, we wouldn't want that to be that. But who knows? We have to investigate. All right. So based on this formula, shares outstanding appears to be the easier one. So let us look into shares outstanding first before moving on to earnings. All right. Okay. So for shares outstanding, this graph here I've taken from Guru Focus. Generally, the trend is on the uptrend, which means the company is issuing more and more shares every year. Okay. Then focusing on the latest year, there is a significant increase from 37.8 million in FY 2020 to 38.3 million in FY 2021. Okay. Then going back to the formula here, okay, having an ever increasing shares outstanding with, let's say, a constant earnings, then in all likelihood the earnings per share would have decreased. Okay. Right, so based on this, we can more or less hypothesize that the ever-increasing shares outstanding could possibly be one of the reasons as to why earnings per share decrease. Okay, but now we only know that this has happened. We don't know why. So let's look back into the annual report to find the reason. Okay. Thankfully, the annual report, they have this segment under the shares portion. They arrange it like a ledger form. Okay, so the top portion is FY 2019, then the middle is FY 2020, the bottom FY 2021. Okay, so we can see that for the FY 2019 and FY 2020, Methode Electronics has been issuing out about 100,000 shares per year. Then this number increased significantly in FY 2021. Okay, then this harkens back to the chart here. That is why there's an increase. But again, we only know that it happened. We don't know why. So let's investigate further. Okay, so after looking through the annual report, it turns out, right, Methode Electronics, they like to do this thing called the stock-based compensation, in which the company would often set aside a certain amount of shares to be awarded to their employees if they perform well. Then such plan was proposed and approved in 2014. Under the 2014 plan, the company set aside 3 million shares to be awarded or given out to the employees. Okay. Then under that plan, in second quarter of the FY 2021, okay, the company has set aside 917,000 shares to be given out as stock awards or stock options if and only if the results for FY 2025 meets the target. Then an additional 458.5 thousand shares can be awarded out, okay, if the results for FY 2025 exceed the target. So if we add these two numbers together, it roughly corresponds to this 1.35 at the bottom here. Okay, and this, ladies and gentlemen, is possibly the reason as to why there is such a big increase in shares outstanding. Okay, so now let's move on to earnings. So for earnings, we'll look at the income statement. Okay, so the top portion, we can see that the net sales, there's a slight increase, whereas the bottom net income, there's a slight decrease. So for the sales to have a slight increase and yet the net income to have a slight decrease, this could only mean one thing. It means that the cost of doing business has increased. So to that, we can look in the numbers box in red that the cost of products sold, as well as the selling and general administrative expenses, has increased slightly. Okay. Now again, we have to look at the reason why there's such an increase. Okay. So thankfully, in the annual report, the management do explain it. Then, thankfully, for them, what they state is that the topmost reason for both criteria is that the they face a certain degree of impact from this thing called the foreign currency translation or foreign exchange. Okay, as you can see in the first sentence. Okay, whereas the cost of products sold, on top of the foreign exchange, okay, there's such thing as the higher operating costs, higher material costs, supply chain shortages, disruptions, etc. All these can be tracked back to the ongoing pandemic. Okay, as for the selling and administrative expenses, the management stated that a significant amount is due to the stock-based compensation, as well as other restructuring costs. Okay. So now let us double confirm this by looking at the aggregate sites data. Okay. So to that we can see that revenue year on year seems to be increasing. At the same time, the cost of goods sold as well as the selling, general and administrative expense also increase in tandem. Then based on the formula listed on the right side, in all likelihood, the costs would have increased in a higher degree compared to the increase in revenue. That is why we get a net decrease in things like gross margin, gross profit, net margin and net income. Okay? And this flows us nicely into this chart here, which is the gross margin chart. Okay? So ideally, we want it to be more than 40%, and if not, it has to be uptrend. So looking at this, it seems to be on an uptrend, which is a good thing. However, in the last couple of years, or in the last half a decade, okay, it seems to be on a plateau. Okay, so we need to keep this in mind. Then the dip in the last year has already been explained in the previous few slides, such as here. Okay. So after gross margin, we will look into cash flow. Cash flow will look at two things: operating cash flow and free cash flow. So for free cash flow is derived by using operating cash flow subtracting the cost capital expenditure. So generally, we want it to be on the uptrend. Okay. Now, looking at this two is on the uptrend, which is a plus sign for value investing criteria. However, right, sometimes we cannot take this as face value. We must look into it. So let's look back into the annual report for more explanation as to why there's such an increase in the last couple of years. Okay. So today we look at the cash flow statement. Okay. The numbers all looks very normal other than two categories: the accounts receivable and the accounts payable. Okay. So accounts receivable, there seems to be a large decrease from a positive number in 2020 to a negative number in 2021. Inversely, for the accounts payable, there's a large increase from a negative number in 2020 to a positive number in 2021. So what does all this means? Basically, it means that for the accounts receivable part, Methode Electronics has been selling on credit. Means that they have sold their product but have not collected payment yet. That is why the term receivable. All right. As for the accounts payable, they're on the flip side. Okay. They had purchased things from their vendors, but they are withholding payment. That is why the term payables. Okay. Then this little relationship here is not uncommon. It appears in a lot of companies, so as to make sure that their cash flow appears liquid. Now, whether is this a good thing or a bad thing, I leave it to individual's judgment. All right. Now we look on to the after this we'll look on to the return on equity and assets. Okay. The formula is listed on the right side, which is net income or earnings divided by equity or assets, resultant times 100%. And for ROE must be more than 15%, ROA must be more than 7%. Now ideally we want it to be on the uptrend. However, unfortunately for Methode Electronics, it seems to be on the downtrend with a dip in the last year. Okay. Then similar to earnings per share, okay, based on the formula, we look at the two moving parts, which is net income or earnings, and see whether does it decrease to give us an overall decrease in the return, or that we look at the equity or assets portion and see that if there's an increase to give us a resultant decrease in the return. Then the worst case we do not want it to happen is that both scenarios happen simultaneously. Okay. Now previously under the earnings portion, we have already established that the net income and net earnings has decreased. Okay. So for now, let's zoom straight into the equity and assets portion. Okay. So to that we can look at the balance sheet. So balance sheet wise, everything also looks normal other than the item accounts receivable. which ultimately gives us an increase in the total assets. The accounts receivable has already been explained here in the cash flow statement. And that is why we have a resultant decrease in the return on assets. All right? So moving on to the equity portion. The equity portion, the numbers also looks very normal other than this item called the accumulated comprehensive income or losses, AOCI for short. So what does this term mean? Is nothing more than just foreign currency translation or foreign exchange. Basically, it means that it is the gains or losses incurred by all the foreign currency exchanges. All right. So all in all, for ROE and ROA to decrease, it is due to a couple of factors. First one, we have the lower earnings or income. Then secondly, we have the larger assets and equity. Okay. Now moving on to debt. Okay. For debt wise, okay, we look at long-term debt and using the debt to equity ratio. So what it is basically a ratio to measure how much the company is borrowing to finance its day-to-day operation, okay, and it's to evaluate the company's leverage, so to say. Then based on value investing criteria, we want the number to be less than 0.5. What it means is that the company should not borrow more than 50% of its day-to-day operations. All right. Now in this case, thankfully for Methode Electronics, most of it has been less than 0.5, which is a plus sign in terms of value investing criteria. Okay. Nevertheless, the methodology wants us to investigate on any significant increase or decrease. Okay. So to that, right, we will look back into the annual report. So the top segment there is just to show that the company has been managing their debt well. Okay. Having a decrease in their last year as compared to the FY 2020. Now, year on year, the management will always reiterate their situation with banks in the sense that they had entered a 5-year credit facility with banks. That is why back here in 2018 to 2019, we have a large increase. All right. Then on top of that, in 2020, the company has borrowed 100 million from the credit facility, right, to safeguard themselves from the uncertainty that the pandemic could bring. And that is why back here, that's why back here in 2019 to 2020, we can see that there's a further increase. All right. Now, thankfully, the management managed to return that amount in 2021. That is why we have a decrease in the debt to equity ratio in the last year. Okay. So now, having known all this, we will go on to our favorite slide, which is the intrinsic value calculation. Okay. So this one, there's a lot of columns, so let me just walk you through. Okay. So based on the latest earnings per share, I've gotten the growth rate to be about 14%. All right. Now, our value investing methodology detects that the adjusted growth rate to be about 50% or at least half of the calculated growth rate, and that's why I input 7 on the first and the third column. Okay. The number 4 on the second and the fourth column is more on a adjusted criteria to be in line with all the uncertainty that has been presented today. All right. Now moving on to step 3, the assumed discounted rate. Okay. Previously, the author of the case study had assumed that Methode Electronics is operating in an unstable environment, and that is why they have input 12 in the assumed discounted rate for the first and the second column. So for the third and the fourth column is more on a default setting, okay, which is 10, where we assume that the company is operating in a normal environment rather than an unstable environment. All right. Now, inflation has been kept at a modest 2% throughout, and the margin of safety we have 30%. Okay. The resultant intrinsic value we have gotten is from about 21 to 30 USD. Okay. Now, one thing to note is that all investors should generally refer to additional steps, evaluation steps, okay, to be as detected by value investing methodology, so as to give us an additional boost of confidence, okay, because one intrinsic value alone isn't enough. All right. So now, having known all of this, right, what we can do, okay, we can do some after action review, okay. So, but before that, I'd like to highlight that the author of the case study previously had already highlighted that the ongoing pandemic is a possible risk for Methode electronics. And this is evident by their increase in costs and expenses incurred in the latest fiscal year. Okay? So now having known all these things, we can, number one, reevaluate intrinsic value by factoring suitable margins of safety as well as the discounts, as what I've done previously right here. Okay? Then additional homework for everyone, for those who are interested in Methode electronics, is that we can utilize additional valuation methods such as price to earnings, price to book, etc. All right. Then some questions that for investors to ponder on is that for those who are interested in the Methode electronics, okay, or those who have already acquired the shares for Methode electronics, okay, has portfolio allocation been done properly so that we are not overly exposed, given that all the uncertainty that has been brought forth today, especially the ongoing pandemic. All right. Then specific to those who have already acquired the shares of Methode electronics, okay, the current share price appears to be more than the intrinsic value as calculated by the author of the case study, as well as the intrinsic value calculated today. So is it a good time to sell, or is it wise to hold on longer? Okay, there is no right or wrong for this question, and there's no fixed answer. It's up to individual judgment. Okay. Right, so with that, we have come to the end of the recap on Methode electronics, and I hope that the tidbits that I provide for you guys today will aid you in your informed decision. All right, so now we move on to the panel discussion, where I invite our speakers, Cayden, Wicked, Dennis, to join me back on stage here for the panel discussion.
Okay, so ladies and gentlemen, welcome back to our VIA Value Investing Symposium. Now, every single one of you will have heard all our speakers starting from Wicked. But before I continue the name, right, when I look at this angle, it appears like we are on some show, you know, where you want to pick husband and so on. But anyway, just aside, we have Wicked, Dennis, and Zhen Hong. So I think they have shared a very detailed analysis of the company. And just to let you know that if you are our existing project US case study subscriber, right, usually our analysis is pretty long, like 45 minutes and sometimes all the way to 1 hour. And because of time, right, we shrink it to 30 minutes. And you may notice that during our presentation, there's no, how should I say, there's no very general statement like trying to guess share price and so on, or technical analysis. So everything is really into the detail, the balance sheets, the ratios, the profit and loss statement, and so on. So when I'm looking at the YouTube live right now, there are about 300 plus people who are watching this. Yeah, so maybe I can ask the audience. Audience, you have any question to ask any of the speakers, any company that you're interested, you know, you can post any question. Yeah, so we have about maybe 20 plus minutes to answer your question. And now it's really a good time, right, for you to ask question. Yeah, maybe while you're trying to figure out what question to ask, let me just share with you some of the structure on how investing is being done. So if you look at the logo at the back, right, when you say Value Investing Symposium, you may realize that there are three words. So Value Investing Symposium. So putting the generic word symposium aside, right, predominantly the first two words stands for value investing. Now, if I can put it simply, what is value investing? Now, value investing is simply means that we want to buy or invest in a company of certain value. That's why the word is called value investing. And values comes in various forms. Some companies are valuable because of what they have in the balance sheet. Yeah, for example, some companies may have land, they may have building, they may have a lot of cash. Yeah, so that company is valuable in a sense based on looking at the balance sheet. So that's one angle of looking at it, right? Okay, let me see any more question coming in. Okay, there's one question coming in. Now, then another way of looking at value, right, is some companies don't really have much things in the balance sheet. So they're asset-like. So for example, my company, I think other than some cash, there's nothing. So laptop, all these are very cheapskate stuff, right? So then what we look at is we look at the company's future ability to produce more cash. Yep, so that lies in the cash flow statement, that lies in the profit and loss statement. Yep, so value, right? So the company can be valuable, look at the balance sheet, the profit and loss statement, or the cash flow statement. But assuming that the company is valuable, then of course you want to buy at a certain reasonable price. And Professor Benjamin Graham once called this a undervalue. But before that, you need to calculate the intrinsic value. So there's one question by Kara Chin, right? I think that question is to Wicked. See whether, is this question okay? So Kara Chin said that the merger deal between Discovery and Warner Media is still open. Should investors wait until deal is sealed before investing? Never mind, just share your opinion.
Okay, so Carol, right?
Yeah.
Okay,
Carol.
Thanks, Carol, for the question. For us itself, we are actually looking at what is their future plans in terms of what they are actually planning to do in the future. So for this question itself, I would say if we were to wait, we might actually miss this opportunity, but definitely different individuals who have different risk appetite. So we are actually doing this sharing to let you know that this is their future plans. And for this, you can actually take into consideration on what is your next step to actually further purchase or to actually wait or actually to, if you own a stock, then maybe you can see what's your next step basically. So in my opinion, I would say this current point of time, as what we have shared just now based on our evaluation, the stock price itself, it's still on a slight high side. So in my opinion, maybe at this point of time, we can still wait a bit longer, or just when you're comfortable with your own risk appetite, you can actually enter the market with Discovery. So that's my opinion in terms of Discovery.
Yeah. So Kara, the Wicked was saying that the current share price, current company, right? Company share price, I think right now is still overvalued. Of course, based on value investing methodology, we wouldn't want to buy overvalued stock. So just based on that alone, I think it's a wait, or it's a hold, right? Then of course the question about the merger deal is quite, how should I say, it's quite difficult for anyone to guess whether would a merger deal take place. Like for example, Minke is asking, right? I'm not very sure, maybe back to Vicky again. See whether you have this information, if not, it's okay, right? So Minke was asking how confident is the merger of Discovery and Warner that's able to beat Netflix, given that Netflix has a large consumer base and increasing good quality Netflix production. I think if I could paraphrase the question could be something like, assuming Discovery and Warner is merged, like how confident, at least from your perspective, that they are able to so-called beat Netflix, assuming that it's merged.
Okay, so thank you, Minke, for the question. Basically, for what I'm thinking of this merging, basically based on what Discovery has been doing from the past few years, right? They actually have a huge acquisition known as Scrip Network. So for the acquisition itself, it's actually one of the largest, and they are actually doing quite well after the acquisition as well. So to answer the question on how confident am I, this I would say I couldn't give too much because I have not really gone through everything, but based on what they have actually proposed so far, it's actually something that they have been working out since this year May. So if everything were to actually go smoothly, they're expecting this combination between the so-called merging between these two companies to happen mid next year. So this few months will be a good time for us to actually gauge what's actually happening between these two companies' discussion, and from there we can actually get a better picture on how this whole thing will actually turns out in the end.
Yeah.
So yeah, that's
okay. Thanks, Vijay. But in short, just now we talk about the company is overvalued, right? So that's one. That's a weight and a hold. And then for the merger, remember, in order for any merger to take place, is anyone guess. But usually a couple of levels. Usually it's a shareholders' approval for the merger, and we want a friendly merger. And then even if the shareholders approve, they have to go through certain different regulatory requirement before the merger take place. So sometimes it may take months, sometimes it may take years. So I think this is really a wait and watch game. Yeah. So that's for Wicked. So everybody is like targeting Wicked, right? So let me just see. Okay, there's another one on Discovery as well. Maybe I just hold on to Discovery, right? Hold on to Discovery. Any other people want to ask about the other two gentlemen over here, which is the Methode Electronics, yeah, as well as the Dennis company.
Euronet.
Yeah, Euronet. Yeah, Euronet. Maybe I just pause it for a short while. Okay. Maybe I pass it to Dennis. Dennis, is there something that you missed out or do you want to add on right now? Now is a good chance because just now you only got 30 minutes. Yeah, so maybe after you, I ask Zhen Hong to add on. You know, just now, a lot of things. Yeah.
Okay.
Maybe you want to share the Euronet. Is there something that you realize?
Actually, I did want to share one thing about Euronet, about something about the electronic fund transfer segment, which is remember I talked about the ATMs, right? So if you're a person who looks at the annual report, just look at the balance sheet. You'll notice that the cash, they actually have two line items. They have one that's cash, and another line item called ATM cash. So you'll find it quite interesting that they have two lines. So obviously, their cash is all their cash, right? But they have to set aside a certain quantum of their cash in ATMs for obvious reasons, right? Because they need to put it at the international airport. But I think you need to be very clear that it's still their money, just that they put it aside for ATMs. Why I say that, let me explain myself. If you look at banks, right, you look at banks' annual reports, if you look at their balance sheet, you'll notice that the cash that they take from customers, those are banks' liabilities. So even though banks hold cash, but the cash is their liability. You understand the difference here? But for Euronet, it's the other way around. The cash that they put in ATMs is really their cash. Because ultimately, whichever international country that they place their ATMs, I believe that the country itself, they work with their own domestic banks to work with Euronet to know whatever money that the customer take out, they'll have an internal arrangement to return the money back to Euronet. Hence, that's why the ATM cash is still considered an asset. So this is something that I want to add on, just to understand the company better.
Yeah. Interesting. Thanks, Dennis. Quite interesting. I mean, everybody want to ask about, I saw some questions about Discovery. Very interesting, right? Everybody like media, Netflix. Maybe it's easier for people to understand. So when it comes to money at ATM, somehow, strangely, people are not so interested. But I'd like to thank Dennis for sharing something. Now, another one, maybe a question just nice for Zhen Hong, right? One of our audience, keep us busy, huh? You see, Ali, right, send the question over here, you see. Okay, so Ali was asking for Methode Electronics, right, the ROA and ROE is dropping. Is it a sign of bad management or there's some insights to the drop of the ROE and ROA?
I think based on what I've shared, right, the drop is mainly because of their earnings for that year, fiscal year, right. The earnings season a lot, but at the same time, the cost has increased significantly due to the ongoing pandemic. So because of this relation, right, that is why the returns, right, is getting more and more lesser. So I say they're squeezing a lot of, the factors are squeezing a lot onto the earnings, so to say. Yeah, that is why the thing dropped out. With regards to management, I do not read into anything regarding bad management now. In fact, the management, they did highlight that they know of all these things and they are actually taking measures to safeguard themselves into falling into a drastic situation. So to that, I read into that, I believe that there is a certain degree of confidence right there.
Okay, very good. So one more question to Zhen Hong, right, just nice. Oh, suddenly all the questions come in. Yeah, the question all come from here. But it's okay, right? So Hong, one gentleman called Kenny, right? He wanted to ask has Methode Electronics done any share buyback? You know, the outstanding shares.
Oh, okay. Who's the guy?
Share buyback.
No, the name.
Kenny.
Thanks, Kenny, for the question. Okay, with regards to share buyback, right? Unfortunately, there is not much share buyback. Most of them, what they have done is that based on their compensation plan, they release the shares to their employees. So we can see that most of the recipients over the years of the shares, right, happen to be their own employees based on the compensation plan. And with regards to share buyback, they didn't say anything. Yeah, so that's an unfortunate case for them. And maybe if there's a degree of loss of confidence right there, right, then maybe for investors, what we can do is either implement a larger margin of safety or just keep this case study as a whole. Because if you're not confident, then better don't do it.
Okay, very good. Now, I remember there's one quote, or rather advice given to me when I met Mary Buffett many years ago. She said, the best way, right, to get out of trouble is to stay out of trouble. So if you are not sure, don't do it. But if you are sure, right, then of course you don't put all your eggs into one basket. You better have some form of asset allocation. And of course, in our 4 days value investing program, we talk about like one industry, right, preferably about 10% or less. And you know the recent drop of Alibaba shares from 300 plus to about 120. Wow, I know a lot of people are jumping. If it's less than 10%, then there's nothing much to jump. But if it's 30% or more, then you need to jump. Okay, so just nice I can go back to Euronet again, which is Dennis, right? So Dennis, there's a question. You see whether, the question from Pam, right? She asked, how is Euronet differentiating themselves from Visa and Master? In first place, are they like competitors? Maybe.
Okay. Yeah, okay. Hi, Pam. Okay, thank you for your question. Okay, Euronet and Visa and Master, they're not direct competitors, right? Because as I mentioned in my presentation, Euronet, you can consider them as a credit card service company. So the reason why I say a service company, because they do like the back-end processing. Right? So in this case, they are not really apple-to-apple comparison. But nonetheless, you can consider them as maybe mildly positive correlated. So in terms of, for example, if you look at their year-to-date performance, you can always compare Euronet with Visa and Master and have a comparison. But I think a better comparison would be more of apple-to-apple, like a company like, say, maybe, for example, like PayPal, which does payment processing. But nonetheless, but you know that because Euronet does a wide range of business, like even they do money remittance, the physical form, right? They do a lot of that. In fact, despite being a technological cutting-edge company, a lot of their revenue still comes from physical, traditional remittances, right? Because the fact is that the money is made from there. Because a huge number of workers overseas still send huge amounts of money back home, and remittance companies earn a lot from that.
Yeah. There's one more question before I go to Wicked, right? Now, this question is, remember just now you talked about the goodwill impairment, and because of that, I think the profit dropped.
Yes.
Okay, so this is from Edmund. Edmund is one of our grad, right? He asked, for Euronet goodwill impairment, does it mean that the company has paid too much? You know, after you impair, the whole thing dropped, right? So he asked whether did it pay too much for the goodwill? Yeah, so he said maximum potential loss is 90% of the total asset. Maybe, about the goodwill
Okay,
impairment.
I think that's a good question by Edmund. So I think just to recap for all listeners is that goodwill in general is the difference between the business valuation and the amount in the balance sheet, right? So that difference is that goodwill. So if you were to say that if the company has overpaid for the business, okay, maybe I put it in a different scenario, right? For example, because now in the pandemic, where increasingly we do everything electronically. So maybe I talk about the acquisition in Greece. So I think the one that they have planning to buy in March 2021 and going to close end of this year, I think they paid about 300 plus million. Right, so the question we ask is that is 300 plus million too much? Right, maybe the Greece that credit card provided maybe is only worth 200 million, but maybe they're paying a premium of 100 million. And I think it's because very often, and that's the reason why you have ratios like price to earnings, so you're always forward looking, right? So, and for example, if you buy a house or property, right, you always usually pay, especially when the market, for example, the supply is low, the valuation is high because there's not enough supply. So naturally, for a company like Euronet, if there's impairment in so many of the key markets, from Greece to even Malaysia and even to Europe like Romania, sometimes a goodwill has to be recognized. Okay, firstly, it's only for accounting reasons, and secondly, I suspect they have to initially overpay to even secure the acquisition. You know what I mean? Because once they secure the acquisition, their market share in that key market will be cemented. You know, so you have to pay a premium to get a cemented place. It's just like, okay, it's just like, I just give another example, maybe a bad example, a fraudulent company like Luckin Coffee. You can remember several years they listed and then they delisted within, you know, when they were found to be fraudulent. But before they were listed, they were expanding like mad, you know, like madness, you know, they just kept opening stores after stores after stores. You know, are they paying it? And then are they, you know, for example, you know, regardless of the rental or whatever, are they paying at a premium? Definitely. They're spending so much because they want to get a market share. But my point here is that in order to get a market share, sometimes you have to pay the price. So in this case, Euronet has to do that.
Okay, so I think back to Edmund's question, I think it's a difficult question. It's so subjective, right? Now, did the company overpay? I think what Danny is trying to say is for any form of merger acquisition, when a big company want to take over a smaller company, they have to overpay. And they so-called inverted commas, they have to pay a premium. Maybe I used the word pay a premium rather than overpay. They have to pay a premium, right, so that the smaller companies, all the shareholders of the smaller companies will vote for the merger. So if they don't pay a premium, I mean, why should they vote for the merger, right? So I think that's one thing. And then if you want to go into the nitty-gritty about like whether is it really overpaying and how much they pay, is it a fair price they pay? So sometimes you have to look at some ratios, right? Such as the enterprise value, right? In proportion to the EBITDA. But it's a bit technical. But in short, for any merger acquisition, if you want to do so-called whether is it overpay, don't overpay, right, relative to another company in the same industry, usually you look at this enterprise value, so slash, right, divided by EBITDA or sometimes EBIT. So now the smaller the number, right, the better is, the cheaper the so-called the acquisition value. Yeah, but this one we just put it aside. But you know that they have to overpay to secure the acquisition, like what Danny is saying. So just nice, I go back to Wicked, right? Now Wicked, this is a generic question. You see whether in the future plan, do you read any? You know, right now the popular thing is about metaverse and metaverse. Okay. And then discovery is in the media, right? Yep. So I'm not very sure in the future plans, have you read something like how are they going to enter into the metaverse world? Yeah. Have you read something like this?
Okay, so the question was from...
okay, maybe the question, okay, this question, this guy didn't write the name, but he said, hi, any further info on discovery in metaverse? Okay. With virtual travel.
I see. Yeah. I think, thanks for the question itself, but I would say, based on my current understanding of Discovery, it's actually a company which is doing more on media streaming rather than going into metaverse, which is actually a whole different topic, because media streaming itself is what we are familiarized with, such as Netflix. So all these things are actually providing us with entertainment. But metaverse, on the other hand, is actually creating another virtual reality for all of us. So in fundamental kind of concept, it's totally different. And based on current Discovery's revenue and what their circle of competence is, it's actually not related to this yet. And frankly speaking, this metaverse itself is actually something very new to everyone, all of us as well. So we are, based on current standing, there is no plans that they will be moving forward because they are still in the media entertainment industry, which providing us with maybe different variety shows and different kinds of educational purposes kind of medias is actually they are focusing. So I would say metaverse is maybe out of topic for now, unless they have further acquisition, maybe for another new companies that they actually venture into metaverse. Yeah, so that would be the answer for the question.
Okay, so in short, for the Discovery, right, it's actually a media streaming company. It's not like a Facebook metaverse company. So there are two dimensions. So I think as of now, the future plan is no. It's no. So just nice, right? I can come back again. So back to the Euronet, right? Euronet. For the Euronet, Fauzi, right? One of our graduates, he's asking. Oh, this is a very interesting question. Okay, and he said the competitors. Number one, who are the competitors? What if electronic payment, right, makes the ATM obsolete? Okay, so first question, competitors, will this electronic payment make the ATM obsolete? Yeah.
Okay, hi Fauzi. Okay, the ATMs, as I mentioned, they are not the ATMs at your, say, at your retail malls and things like that, right? They are really ATMs for essential, you know, when you're transiting from airport to airport, you know, so you need urgently to have some cash, right? So these ATMs will still come into play, right? Because they can dispense multiple currencies based on your point of arrival and point of departure and the arrangements between airports to airports. So one thing is that, as I stress again, right, whether they become obsolete is not because they become obsolete because it's unlikely to become obsolete because there's no demand for it. It's likely to stay because as long as air travel exists, there will be demand for international ATMs at international airports. Right? So that is the question. And ultimately, countries do not want to take the responsibility of having to set up these machines. And that's where Euronet, that's where they outsourced to Euronet to do the job. Right? So that's to answer the question. In my opinion, it will not turn obsolete.
Okay, so one more question for the Euronet.
I think bouncing off from his answer, right, with regards to the ATM, and whether is it obsolete or not, right? Okay, first thing, I'm not subject expert, but what I think, what I feel is that if let's say cashless becomes obsolete, then more or less Euronet will probably just tailor the machine itself to be more of a service kiosk, yeah, rather than serving implementing physical cash. They just implement additional service to keep it relevant. Yeah.
Okay, so there's one more question for Euronet, right? So I think Euronet in 2020, of course, the goodwill and so on, then eventually the net income dropped. So one question by Brandon Tan, right? He was asking, you know, for the year in 2020, how about the performance of other competitors?
Okay, hi Brandon. Okay, so for the purpose of this presentation, I didn't, because of time limitation. Okay, usually as what Cayden said, you know, for case studies, usually the 45 minutes version, I usually have the competitor analysis, right? But because this is the live 30 minutes presentation, so that portion, I did not dive into it. But nonetheless, and it's also, okay, this one is not just a point to note, it's sometimes very difficult to find an exact competitor to Euronet. I just give you an example, is that it's also like, for example, let's give another company like say Tencent, right? It's also very hard to find another competitor to compare with Tencent, because Tencent does so many things, including financing businesses, you know, SMEs, to become unicorns, etc. So it's very hard to find apple to apple. And Euronet is a payment processing company, but yet at the same time, as I mentioned, you know, they earn most of their money through traditional remittances. So they still earn a lot of money from the bread and butter type of job, you know, even though they are technological cutting. So otherwise, you know, for competitors wise, actually what I suggest is that sometimes, you know, if you go to certain screeners like Finvix, you can actually type the Euronet, or you look at the sector they are in. Then go and filter by the sector within America, and you probably will be able to see the different companies in the sector. Yes, and so from there, actually, you can do a competitors. But unfortunately, at this point, I don't have further information on the competitors.
So I think, in short, Dennis may be saying, please subscribe to our Project US case study so that you have further detail on a Euronet versus competitor. Now, that's just a joke. Okay, we have a couple of minutes left, right? Let me see. I think the question is more or less there. So maybe using the precious time there left, maybe what I'll do is I'll maybe starting from Zhen Hong, then we go back to Dennis, and then go back to Wicked. Just to share with all of you, they are all our graduates, and they have been with us for quite a number of years, and every single one is actually our authors. So, but they may not know who is watching this. There are about 300 people watching this. Some people may experience buying stocks. Some people may anyhow hamtam. So maybe I will start from Zhen Hong. You just ponder through, right? After all these years, I also don't know whether your friends invest or not. Now, if there's like one piece of advice, two pieces of advice you want to share with the audience, right, from a personal perspective, I know right or wrong, like what will you tell them? You know, outside there are people like, wow, madhouse. Yeah, so maybe it's Zhen Hong first, then Dennis, then Wicked. Then we end the panel discussion.
Okay, for me, right, the number one advice is make sure you have cash. For me, I more or less started off as a freelancer before I landed onto my current job. So my overall cash pool is quite small. Then I had a lot of missed opportunity. But thankfully, at least I got things started. So there's a certain amount there. But in India, it's still cash. You still need cash. So you still need some degree of cash.
Okay, so cash is important, huh? Okay, thank you, Zhen Hong.
Yeah.
Next one, Dennis, if you can give like 1 or 2 pieces of advice to the audience, right?
So for VIA, of course, we are taught to, one thing is to sell options and collect premium, right? So I think at the end of the day, is trying to be as consistent as possible. So that means you need to just target to tell yourself every month I must earn 1%. So you must do something every month to earn that 1%, so that in 1 year, at least you get a cumulative 12% or more, right? Because sometimes certain options that you sell, I mean, this is for those who may not be aware, sometimes when you sell option, if it hits the target price, you may get assigned the stock. So as what Zhen Hong said, you must have the cash to own the stock. So eventually when you own the stock, the reason why we do value investing is that in the event you own the stock, at least you own it at a fair value or lower. And so your opportunity, other than earning premiums, you can get capital appreciation, right? So your odds of success is higher if you buy a fundamentally sound company. So this is what I want to share with everybody. Thank you.
Okay, so first thing from Zhen Hong, of course, cash is king, right? Cash is important. Then the next one, need to be very disciplined, need to be very regular, right? Okay, maybe if there's 1 or 2 advice.
Yeah, so I think for my side, it's more on having to know value investing. It's very important because with value investing, all of us will have a framework to actually know how to evaluate a company. So with this framework in mind, at least we know what we are actually stepping into, and at the same time, all this will slowly guide you in making a decision that you will be more comfortable in, because the world is actually changing quite fast, and sometimes people will get panicked. So with value investing in everyone's mind, we will have the so-called the baseline, like what Cayden used to share also is that we normally want to buy discounted items. So how do we know whether this is a discounted item or not? So by having this discounted item to purchase in mind, value investing is a framework to actually help us to move towards that direction. So I would say for myself, it will be more on having a good framework will actually get you a very long way.
Okay, thank you. So overall, we have cash, we have discipline, and then we have framework. So we just have a couple of seconds more. We're going to go to the break segment. Now, after the break, be ready, right, for our US case study subscribers. Please stand by your mobile phone because we're going to go to round 1 of your lucky draw. So let's go for our break night right now. Can we give our hands to our authors, please? Thank you. Let's go for our break. Thank you, thank you, thank you. Okay, so ladies and gentlemen, welcome back to our VIA Value Investing Symposium 2021. Oh, I forgot to remove my mask, right? Yeah. Now, so welcome back. Interesting when you do live, right? You know, you see all the little mistakes and so on. Now, this segment is quite interesting, and this segment is our round 1, right, of our lucky draw. And our lucky draw is especially exclusive for our Project USK Study subscribers. Yay! Own self, clap own self in the room. Yeah, so for those people who are watching this live, if you are USK Study subscribers, please type Huada! Now, this is the very first time that we're doing this online lucky draw, right? So in case we a bit mess up a bit, just forgive us. So let's put up the first spin. Oh, but before that, can we see the prize? Yeah, the prize, right? Now, the third prize that we're going to give out to one of our Project USK Study subscriber is an AirBot CM900 handheld dust mite vacuum cleaner. And the reason why we want to give you this, right, is so that if you invest correctly and then safely, you sleep nicely. But before you sleep nicely, we want to make sure that your bedsheet is cleaner. So we're going to give out this AirBot CM900. Okay, luck, come. Let's come for the very first spin. If you look at the screen, see, this is the first time that we're doing this. Quite interesting, right? Okay, the lucky winner for our Project USK study is 187 Roland Chua. Yay! So Shermaine need to do a call, right? Yeah, so give Shermaine some time because quite stressful, right? When I stand here, call already or not? Yeah. Yeah, so Shermaine is going to call, right? As long as you pick it up, we verify your email and so on, right? Then we will give the prices to you lor. Now, while Roland is trying to pick up and so on, just to let you know, if you are the lucky winner, right, you need to arrange to come to office and pick, we will not send the vacuum cleaner to you, right? Yeah, so you need to come. Okay, so don't have ringing. So by the way, we will call twice. If you don't pick up, that's too bad, right? Okay, Roland Chua, please pick up. Okay, pick up, hey. Roland, is that you? Hi, Roland, this is Cayden here.
Hello.
Hello, Roland, is that you? This is Cayden here.
It's Roland, yes.
Hey, Roland, you are our lucky winner for our VIA Symposium.
Thank you, yes. I saw my name, so I got a shock.
You got a shock, You got a shock. If you don't mind, yeah, we just need to verify maybe your email address, right?
Sure.
Yeah, can you just tell us what's your email address?
rchasc@gmail.com.
Okay, good. Confirm. Okay, you are lucky winner. We will contact you. Thank you. Have a great Saturday. Very good. Okay, now the next one. Wow, this is quite xiong. This is quite xiong, but very fun, right? Like Sheng Xiang show. Okay, now the next price, right, is a JBL Tune 500 BT pure bass wireless Bluetooth headphone. Now, if you have sold options before, you know when you hear this, and then you sell option, you can hear the tring sound, right? So we give you a headset. So let's spin the second one. It's quite fun doing this, but the calling one is quite stressed, right? Okay, the lucky winner, yes, number 287 Lee Pin. 287 Lee Pin, right? Lee Pin, please stand by your phone by the side because we're going to call you the moment you pick up. We're going to just going to ask you for the email, and then we'll reach out to you, right, so that you can come to office and collect. Yeah. So right now the phone is ringing. Wow, this one is like a Sheng Xiang show, like that. Like a Sheng Xiang show. Yeah, Lee Pin must pick up. Pick up. Hello, is that Lee Pin? Hello, is that Lee Pin? This is Cayden from VIA. Hello, is that Lee Pin? This is Cayden from VIA. Hello, is that Lee Pin? This is Cayden from VIA. Hello, is that Lee Pin? This is Cayden from VIA.
Hi, Cayden, yes.
Hey, you can hear me, right?
Yes, I can.
Okay, by the way, just to let you know that you are our second prize lucky draw. In case you do not know what is it, it's okay. This is not a spam, right? You want something. Yeah, so I just want to double confirm your email, right? Just tell us your email address, and then once we have verified, we will make arrangement for you to collect the prize. Okay, don't mind, just tell us your email address.
Sure, thank you very much.
Your email address?
Correct? Go on. Yes?
PIN@gmail.com.
That's right.
Okay, that's right. Confirm. Thank you. Have a great Saturday. Thank you. Thank you. Thank you. Bye. He's driving now. Obviously, he's not watching, right? But it's okay. Okay, let's go to the first prize. Wow, first prize is DeLonghi Icona Vintage Kettle. You know, only Charmaine will buy this kind of high-class stuff. Even kettle, she want the high-end one. Okay, let's go for the last spin. Come, let's spin and see who's the lucky winner. You know why we give you the kettle, right? Kettle, so that when you make money, you can drink coffee. Okay, hey, the lucky winner, hey, this one, number 18, Brad Lu. Yay! Brad, come. Wow, like that also can. Wow, this is so funny. Like, hey, serious Brad, you're so lucky. Charmaine, please verify his email address. Come. Okay, she will call you. No, verify email address. Okay, there's nothing, right? Okay, very good. Okay, can we give Brad a round of applause? Thank you. Oh, my Brad, like that also can. Okay, so this is round one, right, of our lucky draw. Wow, this is really funny, huh? I don't know round two whether got any of our audience. Okay, very good. Now, for round two of our prizes, it's going to be more exciting because the first prize, right, is a secret lab chair. Right? But before the second round, we are going to go into the more serious stuff, right? So in the next couple of seconds, I'm going to invite our in-house equity research analyst. Her name is called Raina. She's going to go into really a deep dive. This is her own personal secret, deep dive into this company called NVDA, right? So can we put our hands together and welcome Raina, yay! And congrats to Brad, yay!
Good afternoon, everybody. My name is Rena, and today I'm going to present a presentation on this stock called Nvidia, which is a semiconductor chip stock. So at first, let me tell you what the agenda is. So first, I will be giving a very brief introduction and a company overview, after which we'll talk about 2 acquisitions that the company has done. And after that, we'll talk about the reportable business segments and key market platforms that the company caters to. After which I will talk about the COVID-19 impact on the company, and then we will move on to financials, and then we will talk about the Q3 results update that have been reported recently, and after that we'll talk about the valuation, and lastly the conclusion. So let's begin. So we all know that there is a global shortage in semiconductor chips going on, which has affected many sectors like the tech, auto, and consumer electronics industry and others. So this massive supply chain hiccup is also worsened by the US-China trade war. So there have happened production cuts in lots of items like cars, appliances, smartphones, and all of these things use these semiconductor chips, of which there is a global shortage right now. So even though these industries have been affected by the chip shortage, there are some stocks and investors in these stocks which are not complaining too much. So this chart represents 3 companies, Nvidia, Qualcomm, and AMD. So in these stocks, the price of the stocks in the last 3 months have gained. So for example, Nvidia has gained by 48% in the last 3 months. Qualcomm has risen by 25% and AMD by 47%. So today we are going to talk about Nvidia. So here is a brief company overview. Nvidia was founded in 1993 by 3 Americans, and the present president and CEO is Mr. Yen-Soong Hong, and it is currently headquartered in California. The company IPO'd in 1999 at merely $12, and now it is trading at upwards of $300. Now, Nvidia started as a chip company, but now it has expanded to lots of industries like artificial intelligence, robotics, auto solutions, etc. And you can also find Nvidia in most of the iconic PCs and displays nowadays. So what does Nvidia do exactly? The main focus of the company is the design, development, testing of GPUs. GPUs are graphic processing units. So Nvidia does not manufacture these graphic cards, but it merely designs them. The manufacturing or the fabrication is done by other companies like TSMC, others. So Nvidia is basically a GPU design company, and it uses a platform strategy. So it not only builds these powerful GPUs, but it also combines them with these softwares and hardwares and programmable models, which are then very powerful, and so they can process a lot of AI and ML algorithms for enterprises, which is why people choose Nvidia over its peers. So the processing power of the Nvidia GPU has increased 100,000 times in the last 25 years, which is a great thing. So now Nvidia has always reinvented itself and to stay relevant in the changing times by inorganic growth as well, other than organic growth. So it has recently completed the acquisition of Mellanox, which is basically a company where because of this acquisition, the performance of Nvidia as well as Mellanox increased a lot, and it also increased the data center platform revenues for Nvidia. Now, so basically, the deal resulted in higher performance, greater utilization of computing resources, and also lower operating costs for both companies, and it was very accretive for Nvidia. Now, Nvidia has also entered into a deal to acquire ARM, which is basically a US-based company. And however, this deal has not been finalized yet, as in the merger has not completed. ARM is basically an intellectual property company. What it does is it sells licenses to its architecture, its designs and designs an architecture for GPUs to which it sells the license to other companies, and other companies use these licenses to build their own GPUs. And then, so this deal will unite ARM's ecosystem with NVIDIA's AI platform. And NVIDIA will also be able to cater to other markets like mobile, IoT, and it will also be able to increase investments in ARM as a company. However, this deal has attracted a lot of regulatory pushback because ARM's customers are basically competitors for NVIDIA, and so people think that the number of choices in the GPU market or the innovation or the prices of the GPU market will rise. So this is a major concern. It is an antitrust concern because of which the deal is facing pushback. Now we'll talk about the reportable segments of NVIDIA. There are two reportable segments. First is the graphics platform, where it basically deals with the gaming GPUs that NVIDIA builds, along with workstation graphics and also cloud-based visual and virtual computing. And the second reportable segment is compute and networking, which includes data center platforms and networking solutions and auto solutions and also robotics. So the business segment, the graphics revenue contributes to the majority of the revenue of NVIDIA. So in the year ended January 20, the graphics revenue contributed 70% to the business. However, after 1 year, that is in the year ended January 21, the compute and networking segment has grown a lot. In fact, it has grown from 30% to 41%. So it has eaten up a little bit of share of the graphics segment. So we can see that this was mainly because of the acquisition of Mellanox also. So the revenue from the graphics segment has grown by 29%, mostly because of the growth in gaming GPUs, and the compute and networking segment has grown by more than 100%, which is a great thing for NVIDIA. The compute and networking segment has been growing, and it is expected to, this also includes the data center platform, so it is expected to overtake the gaming segment going forward. Now, NVIDIA caters to 5 market platforms, out of which 4 are key to NVIDIA. First is the gaming platform, then is the data center, the professional visualization, and the automotive platform. So out of these, gaming is the biggest market platform right now, and which is closely followed by data center. However, the growth in data center is so high that it is expected to overtake gaming going forward. So although NVIDIA started with gaming GPU chips, you will notice that it has expanded to so many companies, so it is not just dependent on one segment, which is a great thing for a company. Now we'll talk about the gaming segment. The computer gaming is the largest entertainment industry, and it basically, in the gaming segment, NVIDIA builds the gaming GPUs and sophisticated software enhancements. So the NVIDIA gaming GPUs are very high in quality and performance. These are some of the products under the GPU segment. Then is the data center. The data center, in the data center platform, NVIDIA follows a platform strategy. So it combines the GPUs with software and hardware models and programming models and also frameworks. So it can process a lot of AI and ML transactions, which are very critical for industries in the cloud providers segment. So you can see some of the major customers of NVIDIA are in the cloud industry, like Amazon AWS or Google's cloud platform, etc. Then is the professional visualization segment. Sorry, the screen is not working. So the professional visualization segment, I'll try to explain this segment through examples. So what it basically caters to is that, so suppose there is an engineer or a car maker. So what they will do is that they will build the 3D rendering. They can use the platform of professional visualization to do a 3D rendering of the buildings or the cars that they're designing so that they can view it from all angles and in greater detail. So as you can see, the rendering of the picture on the right hand side shows a rendering of the building that an architect may design so that it can be viewed by people. Next is the automotive segment. So under this segment, NVIDIA mainly caters two products, NVIDIA Drive and the NVIDIA Drive Constellation. So the NVIDIA Drive offers a complete end-to-end solution for the AV market, which is the autonomous vehicle market. So under this, NVIDIA gives self-driving solutions as well as AI assistance. And the NVIDIA Drive Constellation is a simulation where enterprises can test their automotive vehicles before they are commercially deployed. Now, NVIDIA has ventured into the metaverse through NVIDIA Omniverse. So what basically NVIDIA Omniverse can accomplish is that it can give you 3D renderings of almost anything on Earth, which is basically digital twins. So you can have, say, a warehouse or a factory or a showroom of cars on the NVIDIA Omniverse, and like even exhibitions, and you can train robots through this platform. And so you can see that NVIDIA has really reinvented itself with the changing times. And so when metaverse becomes more popular, people will think of NVIDIA first. So these are some of the clients that are already using the Omniverse, like BMW or Canon Design, Epigraph, Ericsson, etc. Now, what was the COVID-19 impact on NVIDIA? So the gaming and data center revenues were increased because of the work from home culture. People were working from home and they were using a lot of computers and gaming devices at home. And in professional visualization as well, the mobile workstations continue to benefit from work from home trends. And initially auto demand was affected, but now it is coming back to normalization. Now moving on to financials. This chart shows the main income statement items for NVIDIA. So we can see that revenue is up by 53%. The gross margins are up by 30 basis points. And the operating expenses have slightly increased, but this is because of the Mellanox acquisition, among other things. And you can see that the net income is up by a whopping 55%, which is a very good sign. So we can see that the revenues and the earnings of the company are increasing. And then we have the various market platforms. So the key point to notice in this section is that the gaming revenue has been increasing, that is by 41%, and the data center revenue has also increased by more than 100%. So it shows that the core business elements of the company have been rising at a good rate. So there is a good future coming on for NVIDIA. Now we'll talk about the revenue trend. So this chart shows the revenue of NVIDIA for the last 10 years. So we can see that the 10-year CAGR, the compounded annual growth rate for NVIDIA is 17%, and that for 5 years is 25%. So the growth rate has also been stable for NVIDIA, even though it dipped slightly in the pandemic year, but now it is catching up again. Now, as you can see here, we have plotted the gross profit of the company. So in the last 5 years, the gross margins have been increasing. It has increased from 58% to 62%, which is a good sign, and except for a slight dip in 2020, which was due to the pandemic. And the same trends can also be seen for operating income as well as net income. Here also, the trend has been upward, except for 1 year, that is 2020. Now this chart shows the major costs of Nvidia as a percentage of the revenue. So the R&D and the selling expenses have remained fairly stable over the years. However, the cost of goods sold as a percentage of revenue have actually declined. So this shows that the company has actually able to reduce its direct costs, which is a good sign. It is a sign of efficiency for the company. Now for liquidity, we see the operating cash flows of the company have remained positive and rising for the past 5 years. So this means that the normal business operations of the company have been able to generate sufficient cash flow to propel the company forward. So going forward, the company will not need to depend on items like debt or equity issue, stuff like that. And we see the same trend in the free cash flow as well. The free cash flow has been rising considerably in the last 5 years, although the margin has fallen slightly in 2021, and that might be because of the acquisition that the company has done, so that uses cash. So a sign of a good company is also that it can create, it has a lot of cash in its hands so that it doesn't depend on debt and equity, and also it can acquire other companies or invest in its own research and development going forward. Now, current ratio is also a liquidity ratio. So we can see that the current ratio for Nvidia is almost 4 times, which is a very good sign for a company. It shows that it has enough cash to fund its debt obligations for the next 1 year. And in fact, if we compare it with its peers, it is above its peers as well, which is a good sign for the company. Coming to the debt to equity ratio, Nvidia's debt to equity ratio, although it has risen in the last 1 year, but it is still below 0.5, which is a good level. So this shows that the company does not depend on debt too much to fund its operations. Now, the recent results of Nvidia for the Q3 have been phenomenal. The company reported strong growth in desktop, laptops, and notebooks. The earnings were, the company beat earnings expectations, and the earnings have increased by 60%, and the revenue has increased by 50% year on year to reach $7 billion. And in the revenue, the gaming platform has risen by 42%, and the data center platform has risen by 55% year on year. So this shows that the core segments of the company are growing, which is a very good sign for the company. Now, if we just compare Nvidia's growth with the other companies like AMD and Intel, we see that although Intel's absolute revenue is the highest, but Nvidia's compounded annual growth rate for the last 5 years is the highest with 25%, followed by AMD at 23%, and then Intel. And when we look at the margins, we see that the free cash flow margin for Nvidia is the highest, and also the gross margin, although the net margin and the operating margin for all the companies are on similar lines. So, but this is because all of these are tech companies and all of these are in the same sector, so they have not been affected by the semiconductor supply shortage a lot. Now we come to valuation. So the market cap of Nvidia is more than $800 billion, which is almost 4 times of its peers. And the PE ratio, although this is not the only ratio that you should see, is approximately 100 times, which is quite alarming. And the price to sales ratio of the company is also quite high. So this means that it is trading at a very big premium to its peers. And some may say that this is also because the company has such great fundamentals. We saw that, you know, it has 60% earnings growth in the most recent quarter, and the revenue growth is also quite solid. So, and another report was published recently, the John Perry research points out that Nvidia controls approximately 83% of the GPU market, which is, and followed by, and the rest is held by AMD. So this also shows that it has a good grip over the market share. So, which is why it commands such high valuations. According to Morningstar, the fair value of the company should be $200, whereas it is trading above $300 right now, so it is at a premium of 67%. And according to Guru Focus, it is currently trading at more than 300 and it should be trading at around 185. So it is basically trading at a premium of almost 70%. So it tells you that the company is very overvalued, but you also have to see that the fundamentals of the company are so good that obviously everyone will want to flock and buy the stock. So now I will give you some closing thoughts about this company. So as we have seen, Nvidia has strong business fundamentals, and the core business segments, the gaming and the data center platform, they are showing accelerated growth. And Nvidia is not just a chip company, although it started by just designing GPUs, but it has expanded to so many other industries and it has made itself useful. So enterprises always prefer Nvidia because it is not just a chip, it provides the entire solution package along with its chips. So it has ventured into auto, EV, crypto, AI, robotics, and now it is also going into the metaverse. So Nvidia is a full package. It's constantly innovating and it is also acquiring new companies to increase its moat, which is a very good sign for a company. However, as we have seen in the previous slide, the stock trades at a rich multiple, and so conservative investors might stay away for it, but growth investors, if they believe that the potential of technology is quite high going forward, then they may buy the stock. However, it is best to stay on the fence and wait for the stock to normalize, to reach normal levels so that your upside potential is increased. With that, I would like to end the presentation, and now we will move on to the second round of the lucky draw for this afternoon. Thank you.
Okay, so ladies and gentlemen, welcome back to round 2 of our lucky draw, and again we have 3 fantastic prizes to be given out. So maybe let's look at the third prize we are giving out for this round 2. Yeah, the third prize is it's a Xiaomi Mi smart speaker with Google Assistant. So in other words, once you win this, right, and then put it at home, so you ask what stock to buy, Xiaomi will tell you what stock to buy, when to buy, and so on. Okay, so this is a joke. Maybe you should try and see whether it works or not. Yeah, so can we spin the wheel, right, and see who's the lucky winner? Yeah, maybe one of the winners will be in this audience. Brad was really lucky. Okay, our third prize goes to number 283, Singi. Oh, I know who is she already. I know her very well. Yeah, she's our NLP graduate, as well as our VIA graduate, and she's also our case study subscriber. She's a real estate agent, right? She's doing very well. Yeah. So Singi, better pick up. I want to give the prize to you. Because she's in real estate, so usually weekend is quite busy, right? Okay, I give you like 5 seconds. If not, we're going to call again. 5, 4, 3, 2. Don't have Maybe you call you one more. Oh, your call failed. Maybe we recall. So Singi, we're going to call one more time, right? Yeah, after this one don't have, then don't have. We'll go for another one. Yeah, with Google Assistant is quite cute. So I'm not very sure if you ask question, would they really reply? Okay, it's ringing, right? It's ringing. Ringing, right? Ringing. Google Assistant.
Hello?
Hey,
Hi.
Singy, Cayden here, leh.
Who? Sorry?
Cayden, Cayden.
Yes.
Hey, Cayden, just to let you know that you won, by the way, this is not a scam call, right? Just to let you know that we're running our online symposium. You just won our third prize, which is a Xiaomi Mi Smart Speaker. So I just need help to tell us your email address. We authenticate, then we make arrangement for you to collect the prize. Don't mind? Tell us your email address.
Okay, it's Singy, SINGYEEL@gmail.com.
That's right.
Correct. Okay, Singy, thank you. We will make arrangement you to collect prize. Thank you. Have a good Saturday. Thank you. Thank you. Bye. Wow, like that also can. Second chance. Wow, okay, very good. So our second prize is, well, again, vacuum cleaner, but this vacuum cleaner is a bit longer. Okay, it's Airbot Supersonic 2.0 cordless vacuum cleaner. And let's go to the wheel right now. Yay! Okay, come, let's spin. So who is our lucky Project US case study subscriber? Maybe Carol, maybe Carol. Oh, D-Raj. Oh, I also know him. Number 142, D-Raj. Okay, it's okay, right? See, for Charmaine, quite stressed. She has to control find what's the number and then press. Oh, the Star Hub is not in use.
Okay, have the next.
Next one, huh? Okay, so let's go for the next one. Let's spin the second round. See whether any live audience here will win the prize, right? Okay, it's 139 Ping Hua. Number 139 Ping Hua. So Ping Hua, I hope you are watching this with the phone beside you. You have just won the second prize with the Airbot Supersonic 2.0 cordless vacuum cleaner. Hello, may I speak to Ping Hua, please? This is Cayden from VIA.
Hi, Cayden.
Hey, hi. Ping Hua, you're right now at home, huh?
Oh, yes.
Oh, just to let you know that we are running an online symposium right now, huh? And the lucky thing is you have won a cordless vacuum cleaner. Is that okay?
Definitely. Thank you. I was paying attention to other winners, but not this round.
Okay, so don't mind you tell us what's your email address, so that we like authenticate, don't mind. Email address.
ngpinghua@yahoo.com.sg.
That's right.
Okay, correct. Congratulations. We'll be contacting you on how we can collect the second prize. Thank you. Have a good Saturday, right? Thank you. Bye-bye. Yay! Yay! Okay, first prize. First prize is the highest prize value, right? Is a Secret Lab Titan Evo 2022 series. Okay, I'm not very sure what is this, but I'm quite sure that at home I don't have this Secret Lab chair. Okay, so the last round, let's spin the wheel. Ding, 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 ding. And see who is the winner. Wow, this one you must collect the chair yourself, huh? Pei Ying, number 52. Pei Ying. Wow, Pei Ying. Pei Ying, we give you two shots. Two shots, right? We call you first. If we didn't pick up, we'll call you one more time. Because we want to give the chair to you, right? We're calling you. Secret lab chair, you can work from home forever, right? Hey, Pei Ying, right? Yeah, Pei. Pei Ying, I give you 5 seconds. If not... Hello, may I speak to Pei Ying? This is Cayden from VIA. This is Cayden from VIA. Pei Ying, are you there?
Hello, Cayden?
Cayden, can you hear me?
Yes.
Hey, just to let you know that we are running an online symposium right now, huh? You have won our first prize. This is not a joke, this is not a joke, right? You have won our first prize, which is a Secret Lab chair, so they can work from home.
Oh, wow, okay, I'm so surprised.
You're so surprised, are you okay with the chair? You're okay, Okay, maybe for authentication, we just need you to tell us our email address. Don't mind, You just tell us the email address.
Okay, sure. It's lpy_86@yahoo.com.sg.
Correct.
Correct. Okay, you are the right person that we're looking for. So Charmaine will be contacting you soon, right, next few days, so that you can arrange to get the chair back home.
Okay.
Okay, thank you. Have a great Saturday. Thank you. Yay. Thank you. So, ladies and gentlemen, can we give all the winners a round of applause? Thank you. Thank you. Okay, by the way, don't leave yet, right? We still have the very important segment right at the back. So maybe I just need to have the slides back up. Yeah, so let's do a very quick wrap up what we have done today, right? But by the way, just to let you know that in front of me, there are maybe about 20 plus people, 20 plus people, and everybody is here to make sure that this online symposium run very well. And actually, surprisingly, things run smoother than I thought. So initially, we were thinking, worried about the lucky draw, we may mess up and so on. So I think everything is quite smooth. Huh? So we started this morning at 10 a.m. and these are our agenda. I talk about how, because of the COVID, the stock market crashed in March 2020, and that's how we started our Project US case study. And then subsequently, 3 speakers came out on stage and then they share their analysis. The first one is Wicked. He talks about discovery. And then the second speaker is Dennis. He talks about Euronet. And then last speaker is Zhen Hong. He talks about Methode electronics. Then of course we have our lucky draw. We have a break with a lucky draw. And then eventually our own in-house, right? Yeah, just to make sure that it works. Now, okay. So, and then subsequently Reina came up and then she shared the Nvidia. Now Nvidia is really an amazing company, and there was one question that YouTube Live talking about metaverse, right? So I think Nvidia fits inside this metaverse, except that I think right now it's a bit overvalued. Huh? In case you buy, you have to pay at the premium. And then of course we have our second lucky draw, and all the 6 prizes. I'm really happy that these 6 prizes are all given away, because I think to us, right, our subscribers have been supporting us since last year. So I think since last year it's been a difficult time for many people, and I think VIA has been around for 11.5 years, and then next year we will turn 12. And I think one of the key things, we are still around, right, because of our graduates who are here, and then in-house we have about 9 people. Remember, right, they can choose not to come, and then but they came. And I think the most priceless thing, right, is they give us their time. That, no matter how much money you have, no money can ever buy a single second of time. So I'm thankful that the 9 people are here. And then for those people who are still watching this, which is the 200 plus people, I'm going to share with you a small little surprise. Right? And just now you already know the whole journey was all about analysis and so on. And then right in the beginning, I shared some of the challenges that any investor will face. First challenge is what to invest in. Yeah, what to invest in, because in the US, we are talking about 3,000 over close to 4,000 companies. So what to invest in. And the next one is when to invest in. And using Reina's example at Nvidia, we know what, but the question is when, right? So even though the company is good, you may not necessarily buy it. And then there's so many companies around, and the recent hot companies are such as Tesla, Palantir. So even if they are good company, is it the right time to buy it right now? And of course, for the past, I think 2-3 months, right, the share price of Alibaba has plunged from about 300 plus to the current new low of 122. Yeah, so there are a lot of people panicking, panicking. So now the question is it a good company? When is the best time to buy? Is it the best time to buy now, or should we wait? So these are some of the questions that all investors will ask, but the good news is we have done something for you, and we have a small little surprise for you. And what is the little surprise, right, that we have done for you, since we have covered all these items in the agenda? So let me just make sure that the clicker is working, right? Yeah, the clicker is not working, so maybe somebody need to help me press the slide, right? But before I end the session today, this is my last slide. Now, as I look at this, right, if you look at the screen over here, or on your screen, you'll be able to see all the authors. Wee Kiet, we have Dennis, we have Zhen Hong, and we have Reina. So I think Reina has done a lot for VA for the past few months. Yeah, so I'm really going to miss her, and to me, right, whether you're with us for 1 month, 2 months, 1 year, 2 years, everybody play a very important role. So these are the speakers I want to thank. So maybe the audience don't mind, can we give them a round of applause? Thank you, thank you. Now the second group of people I want to thank is really the 9 people who have, we have invited them, and then they came all the way from the house and all to this place. By the way, this place quite ulu, huh? Yeah, just now one guy was saying that one of the speakers, Zhen Hong, he was saying he alighted at the train and he spent 18 minutes walking here. So to me, my perspective is, when we invite them to come for this symposium, right, you see they have a choice. They can choose to come, they can choose not to come. And to me, it's okay if they choose not to come, because in the first place, they are not like obligated, they don't really owe us anything. But I think the amazing thing about like friendship, right, is they have chosen to come. And when they choose to come, they have to make an effort. Number one, they had to wake up early, spend their time, figure out a way, and then eventually they came here. And then some people dress very nicely. Yeah, dress, like for example, Christina, like she's dressed to kill, you know. Yeah, maybe she's going to go for a party somewhere. But anyway, every 9 of them, they really spend their precious time here. So I want to give the 9 of them. Can we give the 9 of them a round of applause? Thank you, thank you, thank you. Yeah, thank you, right? So, yeah, and other than the speakers, other than the 9, there's also a crew that's helping us from Noon Talk. But unfortunately, the camera cannot, you know, turn and then look at all these people. And then the crew has also been helping us. So can we give the crew a round of applause? Thank you, thank you. Yeah. And just to let you know that in order for all this event to take place, there's some key people, right, I want to thank. I think the first person I want to thank is Charmaine. Charmaine has been with us coming to 3 years. And then she's like a very PR person. She's very happy. And then just now when we were looking at the lucky draw, we were worried like things may mess up and so on. So sometimes in workplace, we may, you know, have some misalignment, misunderstanding and so on. But she has been with us for quite a while. And she has coordinated so that the 9 people has come. So I really appreciate Charmaine's years of help. So can I give Charmaine a round of applause? Thank you, thank you. Yeah, yeah. So other than this, of course, we have 2 wonderful you know, people with us who help to coordinate this. One person is Irfan, right? Yeah, Irfan, you know, do all the video editing and so on. So if you've been to our YouTube channel, which is at youtube.com/Value Investing Academy, I think some of the videos are shot by Irfan and then edited by Irfan. So Irfan has been with VIA, I think coming to like 1 year, right? Yeah, coming to 1 year. So I still remember when Irfan joined us, his supervisor left. So Irfan was just confirmed. And then after it's confirmed, his supervisor left. Yeah, so I had to spend time talking to Irfan that, you know, we are okay, he's in good hands and so on. So I think I'm thankful that Irfan has chose to stay with VIA, right? So can we give Irfan a round of applause, please? Thank you, thank you. Yeah, and of course, the last key person who is actually our producer is actually Susie. In the next couple of days, right, that will mark Susie's like 3 months with us. So I have a little surprise for her. Maybe somebody, Vicky, can you help me take, you know the chair, right, there's a small little, yeah, correct. Yeah, you can just pass it to me. So this is a surprise. This is like not part of the agenda, right? Yeah, so actually in the next couple of days, Susie will be with us for 3 months. So-called, you know, in the corporate world, it's called confirmation. I didn't, how should I say, I didn't want to tell her first. I want to leave it a surprise. So I was thinking, yeah, I want to give her a surprise. That when should I give her a surprise? Right? Maybe there will never be a good time other than today when there's so many of us here. So can we give Susie a round of applause? Susie, if you don't mind, can you just come, right? Yeah. Susie, yeah, just come. Don't worry, you wear a mask, nobody can recognize you. Yeah, so I'm just going to pass this to you, right? Pass this to you. Okay, thank you, Susie. Can we give Susie a round of applause? Yeah, when she go back to office, I will officially give her the letter. Thank you. So with that, we'll end our VIA's 2021 Value Investing Symposium online. Thank you all. Have a great Saturday. Have a good weekend ahead. Stay safe. Goodbye. Remember, right, at VIA, we care to make you a better investor. Okay, see you soon. Goodbye.